Summary of Money Master the Game: 7 Simple Steps to Financial Freedom by Tony Robbins, Chapter 1.1. It's your money! It's your life! Take control. Tony Robbins begins his book by addressing the profound emotional and psychological impact that money has on people. He asserts that few topics evoke such strong feelings as money, which, like religion, sex, or politics, often remains taboo in social conversations. The mere mention of money can bring about feelings of guilt or shame, depending on one's financial situation. For some, money is essential yet not the ultimate goal. It's merely a tool for living a good life and helping others. For others, the pursuit of money becomes an obsession, leading them to sacrifice their health, time, family, and even integrity. Robbins emphasizes that at its core, money represents power. It has the power to create or destroy, to fund dreams or fuel conflicts. Money can be wielded as a gift or a weapon, used to express creativity or frustration, to influence governments or individuals. Despite its power, money is also an illusion, no longer tied to tangible assets like gold or paper but existing as digital numbers in bank accounts. The meaning of money, Robbins argues, is entirely subjective, shaped by our emotions and perceptions. He challenges the reader to consider what they are truly seeking when they desire money. For most people, the pursuit of money is not about the money itself but about the emotions and experiences it can provide, feelings of empowerment, freedom, security, the ability to help loved ones, and the sense of having choices in life. However, Robbins warns that money can either be a tool that we use to achieve our dreams or a master that controls our lives. He stresses the importance of mastering money to avoid being mastered by it. The concept of money as a game is central to Robbins' approach. He acknowledges that some might find it frivolous to refer to something as serious as money as a game, but he explains that many of the world's wealthiest individuals do indeed view it this way. Robbins shares insights from his interviews with these financial masters, revealing that they continue to work long hours, not because they need more money, but because they see money as a game that they enjoy playing. This perspective, Robbins suggests, is key to understanding and mastering money. Robbins promises that by following the 7 simple steps outlined in the book, readers can achieve financial freedom. He asserts that success in the game of money requires understanding the rules and learning the best strategies from those who have already succeeded. The financial industry often complicates matters to keep people dependent on so-called experts. But Robbins aims to simplify the process, making it accessible to everyone. He encourages readers to imagine a life where money is no longer a source of stress, where financial freedom allows them to live life on their own terms. Robbins paints a picture of what it would be like to wake up each day knowing that there is enough money to cover not only basic needs but also personal goals and dreams. This, he says, is the essence of financial freedom, not necessarily the ability to quit working, but the freedom to work because you want to, not because you have to. Robbins tackles the misconception that financial freedom is unattainable for the average person. He argues that wealth can be created by adding value to others' lives. By becoming more valuable, whether through owning a business, excelling in a profession, or innovating in any field, anyone can earn more, save more, and ultimately invest more. The shift from being a consumer to becoming an investor is crucial in this journey toward financial freedom. He highlights the inadequacy of traditional financial security methods, such as pensions and stable jobs, in today's economic landscape. Robbins points out that the financial world has become increasingly complex, with a plethora of investment options, from mutual funds to exchange-traded funds, ETFs, and complex financial instruments like collateralized debt obligations, CDOs, and mortgage-backed securities, MBS. This complexity often leaves individuals feeling overwhelmed and unsure of how to proceed. Robbins introduces the idea that the key to financial success is not just earning money but also learning to invest it wisely. He asserts that the financial industry often makes money matters seem more complicated than they are, which can discourage people from taking control of their finances. He aims to empower readers to become the chess players, rather than the chess pieces, in the game of money. The chapter also touches on the psychological barriers that prevent people from achieving financial success. Robbins notes that many individuals feel overwhelmed by the complexity of financial management, and are quick to defer to so-called experts. However, He cautions that many financial advisors and brokers are not incentivized to act in their clients' best interests. He encourages readers to take control of their financial education and not to rely solely on the advice of others. To drive home his point, Robbins shares stories of individuals who failed to manage their wealth wisely despite earning millions. He emphasizes that even those who achieve high earnings, like filmmaker Francis Ford Coppola or boxer Mike Tyson, can lose it all if they do not adhere to the fundamentals of financial management. The importance of not just earning money but also holding on to and growing it is a key takeaway. In conclusion, Robbins urges readers to begin their journey toward financial freedom by mastering the basics of money management. He assures them that by following the strategies of financial masters and taking control of their financial future, they can achieve the financial security, independence, and freedom they desire. Chapter 1.2 The 7 Simple Steps to Financial Freedom. Create an Income for Life. In this chapter, Robbins introduces his framework for achieving financial freedom, which he calls the 7 Simple Steps. This chapter lays the foundation for the strategies and principles that will be detailed in the rest of the book, aiming to guide readers toward creating a secure, lifelong income. Robbins begins by addressing the skepticism many people feel about the idea of financial freedom. He acknowledges that the concept can seem elusive, especially in a world where financial security feels increasingly difficult to achieve. However, Robbins emphasizes that financial freedom is not just a dream, it's a reality that anyone can attain by following a systematic approach. The 7 simple steps, according to Robbins, are designed to help people of all financial backgrounds, from those struggling with debt to those already on the path to wealth, achieve financial independence. These steps are the distilled wisdom of some of the world's greatest financial minds, many of whom Robbins interviewed personally. By applying these steps, readers can move from financial insecurity to stability, and ultimately to freedom. Step 1. Make the decision to be financially secure. The first step is making a definitive decision to become financially secure. Robbins stresses the importance of committing to this goal with absolute certainty. This decision is the foundation of all future actions. Without it, the journey cannot begin. Robbins uses this opportunity to highlight the power of decision-making in shaping our lives. He suggests that the moment we truly commit to something, our brain shifts into a state that looks for ways to make it happen. Robbins draws on examples from his own life and the lives of others to illustrate how a single decision can be transformative. He argues that people often fail to achieve financial freedom because they never make a firm decision to pursue it. Instead, they remain stuck in a cycle of wishful thinking, hoping that someday they'll be better off financially without taking concrete steps toward that goal. Step 2. Become the insider. Know the rules before you get in the game. The second step involves becoming financially literate and understanding the rules of the game. Robbins asserts that the financial industry often works against the interests of the average investor, making it crucial to educate oneself about how the system works. He introduces the concept of insiders versus outsiders in the financial world. Insiders are those who understand the true nature of financial products and markets, while outsiders are left in the dark, often manipulated by those in the know. Robbins argues that many financial myths perpetuate the status quo and prevent people from achieving financial freedom. He commits to debunking these myths in later chapters, but the key takeaway here is the necessity of self-education. By becoming an insider, you can make informed decisions and avoid the pitfalls that trap so many others. Step 3. Make the game winnable. In the third step, Robbins emphasizes the importance of setting clear and achievable financial goals. He compares financial planning to a game, where the objective is to win by setting up conditions that ensure victory. Robbins suggests that many people fail to achieve financial freedom because they set goals that are too vague or unrealistic. For example, simply wanting to be rich is not a clear or actionable goal. Instead, Robbins encourages readers to define what financial security means to them personally. This involves calculating the specific amount of money needed to cover basic needs, maintain a desired lifestyle, and achieve long-term goals. By making the game winnable, setting achievable benchmarks and realistic timelines, you increase your chances of success. Step 4. Make the most important investment decision of your life. Step 4 is about asset allocation, which Robbins calls the most critical investment decision you will ever make. He explains that asset allocation is the process of deciding how to divide your investments among different asset classes, such as stocks, bonds, and real estate, to balance risk and reward according to your financial goals and risk tolerance. Robbins emphasizes that proper asset allocation is the key to reducing risk and maximizing returns. He introduces the concept of diversification, which involves spreading investments across various asset classes to protect against significant losses. This step is crucial for building a portfolio that can withstand market volatility and provide steady returns over time. Step 5. Create a lifetime income plan. The fifth step focuses on creating a plan that generates income for life. Robbins explains that the ultimate goal of financial freedom is to ensure that you have enough money coming in to cover your expenses indefinitely, without having to work if you choose not to. This requires developing a strategy that provides consistent, reliable income streams. Robbins discusses various options for creating a lifetime income plan, including investments in annuities, dividend-paying stocks, and real estate. He emphasizes the importance of planning for longevity, as people are living longer today than ever before, which means retirement savings need to last longer. Creating a lifetime income plan is about securing your financial future so that you can enjoy life without the constant worry of running out of money. Step 6. Invest like the 0.001%, the billionaire's playbook. In this step, Robbins dives into the investment strategies used by the ultra-wealthy, the top 0.001% of investors. He highlights that these strategies are not out of reach for the average person and that understanding how billionaires think about and manage their investments can offer valuable lessons. Robbins emphasizes that these strategies involve a combination of risk management, long-term planning, and seizing opportunities when they arise. The key takeaway from this step is that anyone can adopt the mindset and practices of the ultra-wealthy by focusing on long-term growth, protecting against downside risk, and making strategic, informed decisions. Robbins also touches on the importance of continuous learning and adapting to changes in the financial landscape, much like the world's wealthiest investors do. Step 7. Just do it, enjoy it, and share it. The final step is about taking action, enjoying the journey, and sharing your success with others. Robbins stresses that all the knowledge in the world is useless without action. He encourages readers to start implementing the strategies they've learned immediately, rather than waiting for the perfect moment. Robbins also emphasizes the importance of enjoying the process of achieving financial freedom. Money should be a means to an end, not the end itself. He encourages readers to use their financial success to improve their lives and the lives of others, whether through philanthropy, helping loved ones, or simply sharing what they've learned. In conclusion, Robbins' 7 simple steps provide a comprehensive roadmap to financial freedom. By making a firm decision, educating oneself, setting clear goals, making smart investment choices, and taking consistent action, anyone can achieve financial independence and enjoy the peace of mind that comes with it. Chapter 1.3. Tap the power, make the most important financial decision of your life. In this chapter, Robbins zeroes in on what he considers the most crucial financial decision you'll ever make: the decision to save and invest a portion of your income systematically. This chapter builds on the foundational concepts introduced earlier, emphasizing the importance of harnessing the power of compound interest and the discipline required to secure financial freedom. Robbins starts by highlighting the significance of making a simple yet profound commitment: paying yourself first. He argues that the habit of consistently setting aside a portion of your income before paying any other expenses is the cornerstone of wealth building. This decision to save is not just about money, it's a commitment to your future self, ensuring that you have the financial resources needed to live a life of freedom and security. The power of compounding. One of the key concepts Robbins introduces in this chapter is the power of compound interest, often referred to as the eighth wonder of the world. Compounding is the process where the returns on your investments generate their own returns, leading to exponential growth over time. Robbins explains that even small, consistent contributions to your savings can grow into substantial wealth if given enough time to compound. He uses various examples to illustrate how powerful compounding can be. For instance, he contrasts the financial outcomes of 2 hypothetical investors, one who starts saving early in life and another who starts later. The early saver, despite contributing less overall, ends up with significantly more wealth due to the extended period of compounding. This example underscores the importance of starting as soon as possible, no matter how small the initial contributions. Automate your savings. Robbins strongly advocates for automating your savings as a way to ensure consistency and discipline. By setting up automatic transfers from your paycheck or bank account to your savings or investment accounts, you eliminate the temptation to spend the money elsewhere. This set it and forget it approach helps you stay on track with your financial goals without having to rely on willpower alone. He also discusses the psychological benefits of automation, noting that once your savings are automated, you no longer have to worry about making the right decision every month. Instead, you can focus on other aspects of your financial plan, confident that your savings are growing steadily in the background. The importance of asset allocation. Another critical point Robbins makes in this chapter is the importance of asset allocation in achieving long-term financial success. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and real estate, to balance risk and reward according to your financial goals and risk tolerance. Robbins emphasizes that proper asset allocation is more important than choosing individual stocks or timing the market. By spreading your investments across a diverse range of assets, you can reduce the risk of significant losses and increase the likelihood of achieving consistent returns. This approach is particularly important for long-term investors who need to protect their wealth from market volatility. Overcoming the fear of loss. One of the biggest barriers to investing, Robbins acknowledges, is the fear of loss. Many people are hesitant to invest because they worry about losing their hard-earned money in the stock market. However, Robbins argues that this fear is often based on a misunderstanding of how markets work. He explains that while market downturns are inevitable, they are also temporary. Historically, markets have always recovered from declines, often reaching new highs. Robbins encourages readers to view market fluctuations as opportunities rather than threats, as downturns can present the chance to buy high-quality assets at lower prices. To help readers overcome their fear of loss, Robbins introduces the concept of dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By consistently investing over time, you can reduce the impact of market volatility and avoid the pitfalls of trying to time the market. The Rule of 72. Robbins also introduces the Rule of 72, a simple formula that helps you estimate how long it will take for your money to double based on a fixed annual rate of return. By dividing 72 by the annual interest rate, you can quickly determine the number of years it will take for your investment to double in value. For example, if your investments earn an average annual return of 8%, your money will double approximately every 9 years. 72 divided by 8 is equal to 9. This rule underscores the power of compounding and the importance of earning a reasonable return on your investments. Robbins uses this concept to illustrate how even modest improvements in your rate of return can have a significant impact on your long-term wealth. Avoiding common pitfalls. Robbins warns readers about common mistakes that can derail their financial plans. One such mistake is trying to time the market, which he argues is nearly impossible to do consistently. Instead, he advocates for a long-term, disciplined approach to investing, where you stay the course regardless of short-term market movements. He also cautions against allowing emotions to drive financial decisions. Fear and greed are powerful emotions that can lead to poor investment choices, such as selling during a market downturn or chasing after the latest investment fad. Robbins stresses the importance of sticking to your financial plan and making decisions based on logic and strategy rather than emotion. The Freedom Fund. Robbins introduces the concept of a Freedom Fund, a dedicated account that represents your financial independence. The idea is to build this fund over time until it can generate enough income to cover your living expenses, allowing you to live without relying on a traditional job. He encourages readers to visualize their Freedom Fund as a source of empowerment, a tangible representation of the freedom they are working toward. By regularly contributing to this fund and watching it grow, you can stay motivated on your journey to financial freedom. Robbins concludes the chapter by reminding readers that the journey to financial freedom requires discipline, patience, and a long-term perspective. By making the most important financial decision of your life, committing to save and invest, you set the stage for lasting financial security and independence. Chapter 1.4 Money Mastery. It's time to break through. This chapter focuses on the concept of money mastery, urging readers to break through their psychological barriers and limiting beliefs about money. This chapter delves into the mental and emotional aspects of financial success, emphasizing that mastering money is as much about mindset as it is about strategy. Robbins begins by addressing the common misconceptions and fears that hold people back from achieving financial freedom. He argues that many of these limiting beliefs are rooted in societal conditioning and personal experiences, which can create a mental block that prevents individuals from taking control of their financial future. Robbins encourages readers to identify and challenge these beliefs, replacing them with empowering thoughts and attitudes. The psychology of wealth. Robbins introduces the concept of the psychology of wealth, which he describes as the mindset that allows individuals to attract and maintain wealth. He argues that wealth is not just about money, it's about the beliefs, values, and attitudes that shape our financial decisions. According to Robbins, the key to financial mastery is developing a psychology that supports abundance rather than scarcity. He explains that people with a scarcity mindset often focus on what they lack, which can lead to fear, anxiety, and poor financial decisions. In contrast, those with an abundance mindset believe that there is enough wealth and opportunity for everyone, which fosters confidence, creativity, and a willingness to take calculated risks. The power of beliefs. Beliefs play a crucial role in shaping our financial reality, Robbins asserts. He explains that our beliefs about money are often formed in childhood, influenced by our parents, culture, and early experiences. These beliefs can be empowering or limiting, depending on whether they align with our goals and values. Robbins encourages readers to examine their core beliefs about money and identify any that may be holding them back. For example, a belief that money is the root of all evil can create a subconscious resistance to wealth, leading to self-sabotage. Similarly, a belief that rich people are greedy can prevent individuals from pursuing financial success. To break free from limiting beliefs, Robbins suggests replacing them with more empowering ones. He recommends using affirmations and visualization techniques to reinforce positive beliefs and create a mental environment conducive to wealth creation. The cycle of success. Robbins introduces the concept of the cycle of success, a feedback loop that reinforces positive financial behaviors. The cycle begins with beliefs, which influence thoughts, which in turn drive actions. These actions produce results, which then reinforce the original beliefs, creating a virtuous cycle of success. For example, if you believe that you can achieve financial freedom, this belief will lead to thoughts of possibility and opportunity. These thoughts will inspire you to take action, such as saving, investing, and seeking financial education. As you begin to see positive results, your belief in your ability to succeed will grow stronger, further motivating you to continue on the path to wealth. Robbins emphasizes that breaking the cycle of failure and creating a cycle of success requires a conscious effort to change your beliefs and behaviors. He encourages readers to take control of their financial destiny by adopting the mindset and habits of successful individuals. Overcoming financial stress. Financial stress is a significant barrier to money mastery, Robbins notes. He explains that stress can lead to poor decision-making, as it activates the brain's fight-or-flight response, which is not conducive to rational thinking. When people are stressed about money, they are more likely to make impulsive decisions, such as overspending, taking on high-interest debt, or selling investments at a loss. Robbins offers strategies for managing financial stress, including mindfulness practices, exercise, and maintaining a positive perspective. He also suggests breaking down financial goals into manageable steps, which can reduce feelings of overwhelm and increase the likelihood of success. The role of gratitude. Gratitude is another powerful tool for mastering money, according to Robbins. He explains that practicing gratitude shifts your focus from what you lack to what you already have, which can help reduce financial stress and increase feelings of abundance. Robbins encourages readers to regularly express gratitude for the wealth and opportunities they have, no matter how small, as this practice can attract more of the same into their lives. He also discusses the importance of giving back, noting that generosity is a key component of the wealth mindset. By contributing to others, Whether through charitable donations or acts of kindness, you reinforce the belief that there is enough wealth to go around and that you are capable of making a positive impact in the world. Building financial confidence. Confidence is a critical factor in achieving financial mastery, Robbins asserts. He explains that confidence comes from knowledge and experience, both of which can be developed over time. By educating yourself about personal finance and taking consistent action, you build the confidence needed to make informed decisions and take calculated risks. Robbins encourages readers to seek out financial education through books, courses, and mentorship, as well as to practice making financial decisions in real-life situations. He stresses that mistakes are an inevitable part of the learning process and should be viewed as opportunities for growth rather than failures. Robbins concludes the chapter by reminding readers that financial mastery is a journey, not a destination. It requires continuous effort, learning, and self-reflection. However, by adopting the principles outlined in this chapter, anyone can develop the mindset and habits necessary to achieve lasting financial success. Chapter 2.0 Break Free, Shattering the 9 Financial Myths. In this chapter, Robbins tackles some of the most pervasive myths surrounding personal finance and investing. These myths, he argues, are often propagated by the financial industry and serve to keep individuals from achieving true financial freedom. By exposing these myths and replacing them with truths, Robbins aims to empower readers to make better financial decisions. Myth 1. Invest with us. We'll beat the market. The first myth Robbins addresses is the claim that professional money managers can consistently beat the market. He explains that while this is a common promise made by mutual funds and financial advisors, the reality is that very few actively managed funds actually outperform the market over the long term. Robbins cites studies showing that the vast majority of mutual funds fail to beat the market after fees are taken into account. He introduces the concept of index funds as an alternative to actively managed funds. Index funds track the performance of a specific market index, such as the S&P 500, and typically have lower fees than actively managed funds. Over time, index funds often outperform their actively managed counterparts, making them a more reliable investment option for most individuals. Myth 2. Our fees? They're a small price to pay. The second myth revolves around the notion that investment fees are a minor consideration. Robbins argues that fees can have a significant impact on your investment returns over time, particularly when compounded over decades. He explains that even seemingly small fees, such as a 1% management fee, can erode a substantial portion of your wealth. Robbins advises readers to be vigilant about the fees they are paying and to seek out low-cost investment options whenever possible. He also discusses the importance of understanding the different types of fees associated with various investment products, such as expense ratios, trading fees, and advisory fees. Myth 3. Our returns? What you see is what you get. The third myth Robbins debunks is the idea that the returns advertised by mutual funds and other investment products are the returns you will actually receive. He explains that advertised returns are often gross returns, which do not account for fees, taxes, and other costs that can significantly reduce your net returns. Robbins emphasizes the importance of looking at net returns, the actual amount of money you take home after all expenses are deducted. He encourages readers to ask their financial advisors or fund managers for net return figures rather than relying on the often misleading gross return numbers. Myth 4. I'm your broker, and I'm here to help. In this section, Robbins addresses the myth that financial advisors and brokers are always acting in your best interest. He explains that many financial professionals are incentivized to sell specific products, regardless of whether those products are the best choice for the client. This conflict of interest can lead to recommendations that benefit the advisor more than the client. Robbins introduces the concept of a fiduciary, a financial advisor who is legally required to act in the best interests of their clients. He advises readers to seek out fiduciaries and to be cautious of advisors who are compensated through commissions or other incentives that may influence their recommendations. Myth 5. Your retirement is just a 401k away. The fifth myth challenges the belief that simply contributing to a 401k is enough to secure a comfortable retirement. Robbins argues that while 401ks can be a valuable tool for retirement savings, they are often not sufficient on their own. He points out that many 401k plans have limited investment options, high fees, and do not provide the level of diversification needed for long-term growth. Robbins encourages readers to supplement their 401k's with other investment vehicles, such as IRAs, Roth IRAs, and taxable investment accounts. He also discusses the importance of maximizing employer matching contributions and taking advantage of tax-advantaged accounts to boost retirement savings. Myth 6. Target date funds, just set it and forget it. Robbins addresses the myth that target date funds, mutual funds that automatically adjust their asset allocation as you approach retirement, are a foolproof investment strategy. While target date funds are marketed as a simple, hands-off solution for retirement investing, Robbins argues that they often fall short in delivering the best returns. He explains that target date funds tend to be overly conservative as they approach the target retirement date, which can limit potential growth. Additionally, these funds often come with higher fees and less flexibility than other investment options. Robbins suggests that a more personalized asset allocation strategy, tailored to your specific needs and goals, may be a better approach. Myth 7. I hate annuities, and you should too. The seventh myth Robbins debunks is the widespread disdain for annuities, a type of financial product that provides a steady income stream, typically for life. While annuities have a bad reputation due to high fees and complex structures, Robbins argues that they can be a valuable tool for securing guaranteed income in retirement. He explains the different types of annuities, such as fixed, variable, and indexed annuities, and discusses the pros and cons of each. Robbins advises readers to carefully evaluate annuities and consider them as part of a diversified retirement income strategy, particularly for those who value security and peace of mind. Myth 8. You gotta take huge risks to get big rewards. The eighth myth challenges the belief that high returns are only possible through high-risk investments. Robbins argues that while risk and reward are often correlated, it is possible to achieve substantial returns without taking on excessive risk. He introduces the concept of asymmetric risk-reward, where the potential upside of an investment significantly outweighs the downside risk. Robbins shares examples of investment strategies that offer favorable risk-reward profiles, such as certain types of real estate investments, value investing, and option strategies. He encourages readers to seek out opportunities that offer high returns with manageable risk, rather than chasing high-risk, high-reward investments that could lead to significant losses. Myth 9. The lies we tell ourselves. The final myth Robbins addresses is the lies we tell ourselves about money and investing. These lies often stem from fear, insecurity, and a lack of financial education. Common lies include, I'll start saving when I make more money, I'm not good with numbers. Or, it's too late for me to start investing. Robbins argues that these self-imposed limitations are the biggest barriers to financial success. He encourages readers to confront and challenge these lies, replacing them with empowering beliefs and a commitment to taking action. By changing your mindset and taking control of your financial education, Robbins asserts that anyone can achieve financial freedom. Chapter 2.1. Myth 1. The $13 trillion lie, invest with us. We'll beat the market. In this chapter, Tony delves deeper into the first financial myth he introduced in the previous chapter, the widespread belief that professional money managers can consistently beat the market. Robbins refers to this as the $13 trillion lie, highlighting the vast amount of money invested in actively managed mutual funds that promise to outperform market indices. The reality of active management. Robbins begins by explaining the concept of active management, where professional fund managers attempt to outperform a specific market index, such as the S&P 500, by selecting a portfolio of stocks they believe will do better than the market as a whole. These managers often charge higher fees for their services, justifying the cost by promising superior returns. However, Robbins quickly dispels this notion by citing research and data that show the majority of actively managed funds fail to beat their benchmark indices over the long term. He points out that while some funds may outperform in a given year, very few can do so consistently year after year. Over time, the high fees associated with active management often erode any potential gains, leaving investors worse off than if they had simply invested in a low-cost index fund. The cost of underperformance. Robbins emphasizes the significant financial impact of underperforming actively managed funds. He explains that even a small difference in annual returns can have a dramatic effect on the value of an investment portfolio over time, especially when compounded over decades. For example, a 1% lower annual return due to high fees can reduce the total value of an investment portfolio by hundreds of thousands of dollars over a lifetime. To illustrate this point, Robbins shares examples of investors who have lost substantial amounts of money by trusting in actively managed funds that failed to deliver on their promises. He contrasts this with the consistent performance of index funds, which track the overall market and typically charge much lower fees. The appeal of index funds. Robbins introduces index funds as a more reliable and cost-effective alternative to actively managed funds. Index funds are designed to replicate the performance of a specific market index by holding a portfolio of stocks that mirror the composition of that index. Because they require less active management, index funds have much lower fees than actively managed funds. Robbins explains that over time, the majority of index funds have outperformed their actively managed counterparts, particularly when fees are taken into account. He encourages readers to consider index funds as a core component of their investment strategy, highlighting their simplicity, transparency, and low cost. The myth of the star manager. Robbins also addresses the myth of the star manager, the idea that certain fund managers possess a unique talent or insight that allows them to consistently outperform the market. He argues that while there may be a few exceptional managers who can achieve this, they are extremely rare, and their success is often fleeting. Moreover, by the time a star manager's success becomes widely known, the opportunities they capitalized on may no longer be available. Robbins cautions against chasing after the latest hot fund or manager, noting that past performance is not indicative of future results. He stresses the importance of sticking to a disciplined investment strategy, rather than trying to time the market or pick winning managers. The importance of long-term perspective. Throughout the chapter, Robbins emphasizes the importance of maintaining a long-term perspective when investing. He explains that short-term market fluctuations are inevitable and should not distract investors from their long-term goals. By investing in low-cost index funds and staying the course, investors can benefit from the overall growth of the market over time, rather than getting caught up in the short-term ups and downs. Robbins also highlights the importance of diversification, not just within a single asset class but across different asset classes as well. He explains that a well-diversified portfolio can help reduce risk and smooth out returns over time, providing a more stable foundation for long-term wealth building. By debunking the myth of active management, Robbins empowers readers to take control of their investments and make informed decisions that will help them achieve their financial goals. Chapter 2.2. Myth 2: Are fees? They're a small price to pay. Here, Robbins continues his exploration of financial myths by tackling the misconception that investment fees are a minor consideration when it comes to building wealth. He argues that this myth is one of the most dangerous because it can significantly erode the value of your investments over time, often without you even realizing it. The hidden costs of high fees. Robbins begins by explaining the different types of fees associated with investing, including management fees, administrative fees, and trading costs. These fees are often expressed as a percentage of your assets under management, AUM, and may seem small at first glance, typically around 1% to 2% per year. However, Robbins warns that even small fees can add up to a significant amount of money over time, especially when compounded over several decades. To illustrate the impact of fees, Robbins presents a simple example. If you invest $100,000 and earn a 7% annual return with no fees, your investment would grow to $574,349 after 30 years. However, if you paid just 2% in annual fees, your net return would drop to 5%, and your investment would only grow to $432,194 over the same period, a difference of over $140,000. This example highlights how high fees can drastically reduce your potential wealth, even if the difference in annual returns seems small. The illusion of net returns. Robbins also discusses the concept of net returns, the actual amount of money you take home after all fees and expenses are deducted. He explains that many investors focus on gross returns, which are often advertised by mutual funds and financial advisors, without considering the impact of fees. This can create the illusion that your investments are performing better than they actually are. To combat this, Robbins encourages readers to always look at net returns when evaluating investment options. He suggests asking your financial advisor or fund manager to provide clear information on the total fees associated with your investments, as well as the net returns after those fees are deducted. This transparency is crucial for making informed decisions and avoiding the pitfalls of high fees. The impact of fees on retirement savings. Robbins emphasizes that the impact of fees is particularly significant when it comes to retirement savings. Because retirement accounts are typically invested over several decades, the compounding effect of fees can dramatically reduce the amount of money you have available in retirement. He points out that many 401k plans, for example, have high fees that can eat into your retirement savings without you even realizing it. To address this issue, Robbins advises readers to carefully review the fees associated with their retirement accounts and consider switching to lower-cost options if possible. He also suggests exploring alternative retirement savings vehicles, such as IRAs or Roth IRAs, which may offer lower fees and more flexibility than traditional 401k plans. The case for low-cost investing. Throughout the chapter, Robbins makes a strong case for low-cost investing. He highlights the benefits of index funds and exchange-traded funds, ETFs, which typically have much lower fees than actively managed mutual funds. These low-cost options allow investors to keep more of their returns, which can lead to significantly greater wealth over time. Robbins also discusses the importance of understanding the fee structures of different investment products. For example, some mutual funds charge a front-end load, a fee paid when you purchase shares, or a back-end load, a fee paid when you sell shares. Others may have hidden fees that are not immediately apparent, such as trading costs or administrative expenses. By being aware of these fees and choosing low-cost alternatives, you can maximize your investment returns. The fiduciary standard. One of the key themes of this chapter is the importance of working with a fiduciary, a financial advisor who is legally required to act in your best interest. Robbins explains that many financial advisors are compensated through commissions or other incentives that may influence their recommendations. This can create a conflict of interest, where the advisor's recommendations are driven by their own financial gain rather than the client's best interests. Robbins advises readers to seek out fiduciaries who are transparent about their fees and committed to providing unbiased advice. He suggests asking potential advisors about their compensation structure and whether they adhere to the fiduciary standard. By working with a fiduciary, you can ensure that your advisor is focused on helping you achieve your financial goals rather than simply selling you products. Chapter 2.3. Myth 3: Are returns? What you see is what you get. In this chapter, Robbins continues to dismantle financial myths by focusing on the misconception that the returns advertised by mutual funds and other investment products are the returns investors actually receive. Robbins argues that the returns touted by financial advisors and mutual fund companies are often misleading, as they do not account for various fees, taxes, and other hidden costs that can significantly reduce the actual returns an investor experiences. The difference between average returns and real returns. Robbins begins by explaining the difference between average returns and real returns, a distinction that is crucial for understanding the true performance of your investments. Average returns, often advertised by mutual funds, represent the mean return over a period, but they can be deceptive. For example, if a fund gains 50% one year and loses 50% the next, the average return would be 0%, but the real return would be negative because the investor would have less money than they started with. Real returns, on the other hand, take into account the actual dollar value of your investments over time, factoring in the effects of compounding, fees, and taxes. Robbins emphasizes that investors should focus on real returns, as they provide a more accurate picture of how much money they are actually making, or losing, over time. The impact of fees on returns. A significant portion of the chapter is devoted to discussing how fees can drastically reduce the real returns on investments. Robbins reiterates that many mutual funds and financial advisors advertise gross returns without disclosing the impact of fees. These fees can include management fees, administrative costs, and transaction fees, all of which can eat into your profits. To illustrate this point, Robbins provides examples of how a seemingly small fee, such as 1% or 2% per year, can compound over time to result in a substantial reduction in wealth. For instance, a 2% annual fee may seem minor, but over 30 years, it can reduce your total returns by as much as 40% or more. This example underscores the importance of being aware of all fees associated with your investments and seeking out low-cost options whenever possible. The role of taxes. In addition to fees, Robbins discusses the impact of taxes on investment returns. He explains that taxes on capital gains, dividends, and interest income can significantly reduce the amount of money you take home. Many mutual funds do not factor in the tax implications when they advertise their returns, leading investors to believe they are earning more than they actually are. Robbins advises readers to consider tax-efficient investment strategies, such as holding investments in tax-advantaged accounts like IRAs or 401(k)s, which can help minimize the impact of taxes on their returns. He also suggests working with a financial advisor who understands tax planning and can help structure your investments in a way that maximizes after-tax returns. Survivorship bias in mutual fund performance. Another important concept Robbins introduces in this chapter is survivorship bias. This occurs when only the successful funds are included in performance statistics, while underperforming or failed funds are excluded. As a result, the average returns reported by mutual fund companies may be artificially inflated, as they do not account for the funds that have been closed or merged due to poor performance. Robbins explains that this bias can give investors a false sense of security, leading them to believe that mutual funds perform better than they actually do. To avoid falling victim to survivorship bias, Robbins encourages readers to look at the long-term performance of funds, including those that no longer exist, and to consider investing in broad-based index funds that do not rely on the performance of individual managers. The importance of transparency. Transparency is a key theme in this chapter, as Robbins emphasizes the need for investors to demand clear and honest information about the true costs and returns of their investments. He advises readers to ask their financial advisors or fund managers for detailed breakdowns of all fees and expenses, as well as the net returns after these costs are deducted. Robbins also encourages investors to be skeptical of marketing materials and to do their own research when evaluating investment options. By focusing on real returns and understanding the impact of fees, taxes, and other hidden costs, investors can make more informed decisions and avoid the pitfalls of relying on misleading performance metrics. Chapter 2.4. Myth 4: I'm your broker, and I'm here to help. In this chapter, Robbins confronts the myth that financial brokers and advisors are always acting in the best interest of their clients. He argues that this assumption is not only misguided but can be detrimental to an investor's financial health. Robbins emphasizes the importance of understanding the potential conflicts of interest that exist in the financial industry and how these conflicts can influence the advice you receive. The fiduciary standard versus the suitability standard. Robbins begins by explaining the difference between two key standards that govern financial advisors: the fiduciary standard and the suitability standard. Advisors who operate under the fiduciary standard are legally required to act in the best interest of their clients. This means that they must recommend investments that are best suited to the client's needs and financial situation, regardless of whether those investments generate higher commissions or fees for the advisor. In contrast, advisors who operate under the suitability standard are only required to recommend investments that are suitable for the client, even if those investments are not the best possible option. This standard allows brokers and advisors to recommend products that may offer higher commissions or incentives for them, even if those products are not the most cost-effective or beneficial for the client. Robbins warns that many financial advisors and brokers operate under the suitability standard, which can lead to conflicts of interest and biased recommendations. He advises readers to seek out fiduciaries who are legally obligated to put their clients' interests first. The hidden costs of commissions. Robbins delves into the various ways in which brokers and advisors are compensated, highlighting the potential conflicts that arise when they are paid through commissions. He explains that brokers often earn commissions on the financial products they sell, such as mutual funds, insurance policies, or annuities. This compensation structure can incentivize advisors to recommend products that generate higher commissions for them, even if those products are not the best choice for the client. To illustrate this point, Robbins shares examples of how commission-based compensation can lead to biased advice. For instance, a broker may recommend a high-cost mutual fund with a front-end load, a fee paid when you purchase the fund, because it pays a higher commission, even though a low-cost index fund would be a better option for the client. These hidden costs can significantly reduce an investor's returns over time. The influence of revenue sharing. Robbins also discusses the practice of revenue sharing, where mutual fund companies or other financial product providers pay brokers and advisors to promote their products. This arrangement can create a conflict of interest, as advisors may be more likely to recommend products from companies that offer the most lucrative revenue-sharing agreements, rather than those that are best suited to the client's needs. Robbins emphasizes the importance of transparency and encourages readers to ask their advisors about any revenue-sharing agreements or other incentives that may influence their recommendations. He suggests that clients should demand full disclosure of all fees and compensation arrangements to ensure that they are receiving unbiased advice. The dangers of proprietary products. Another issue Robbins addresses is the promotion of proprietary products by financial firms. Proprietary products are investment products created and sold by the firm itself, rather than by an external provider. These products often carry higher fees and may not be the best option for the client, but they are heavily promoted because they generate higher profits for the firm. Robbins warns that advisors working for large financial institutions may be pressured to recommend proprietary products over other options, even when they are not in the client's best interest. He advises readers to be cautious of any advisor who primarily recommends proprietary products and to consider seeking a second opinion from an independent advisor. How to protect yourself. Robbins offers practical advice on how to protect yourself from conflicts of interest and biased advice. He suggests asking potential advisors whether they operate under the fiduciary standard and whether they receive commissions or other incentives for recommending certain products. He also recommends reviewing the advisor's compensation structure and asking for a detailed breakdown of all fees and expenses associated with the recommended investments. Robbins encourages readers to be proactive in their financial education and to do their own research before making investment decisions. He also suggests considering working with a fee-only advisor, who is compensated solely through fees paid by the client and does not receive commissions or other incentives for recommending specific products. This arrangement can help ensure that the advisor's recommendations are truly in the client's best interest. Chapter 2.5. Myth 5: Your retirement is just a 401k away. This chapter challenges the widely held belief that contributing to a 401k plan is all that is needed to secure a comfortable retirement. While 401k plans can be an essential component of retirement savings, Robbins argues that relying solely on them can be a mistake. He highlights the limitations of 401ks, the hidden fees associated with them, and the need for a more comprehensive retirement strategy. The limitations of 401k plans. Robbins begins by acknowledging that 401k plans have become the primary retirement savings vehicle for many Americans, particularly after the decline of traditional pension plans. However, he points out that 401ks were never intended to be the sole source of retirement income. They were originally designed as a supplemental savings tool for higher-income earners, not as a replacement for pensions. One of the key limitations of 401k plans that Robbins discusses is the lack of investment options. Many 401k plans offer a limited selection of mutual funds, often with high fees and mediocre performance. This lack of choice can prevent investors from building a well-diversified portfolio that aligns with their financial goals and risk tolerance. Robbins also notes that 401k plans are subject to market risk, meaning that the value of your retirement savings can fluctuate based on market conditions. This can be particularly problematic for individuals nearing retirement, as a market downturn could significantly reduce the value of their 401k at the time when they need it most. The hidden costs of 401k plans. A significant portion of the chapter is devoted to the hidden costs associated with 401k plans. Robbins explains that many 401k plans come with a variety of fees, including management fees, administrative fees, and transaction costs. These fees can significantly reduce the growth of your retirement savings over time, especially when compounded over several decades. Robbins emphasizes the importance of understanding the fees associated with your 401k plan and seeking out lower-cost options whenever possible. He suggests asking your plan administrator for a detailed breakdown of all fees and expenses and considering alternative investment options if the fees are too high. He also discusses the impact of revenue sharing, where mutual fund companies pay 401k plan providers to include their funds in the plan's investment lineup. This practice can lead to higher fees and may not always result in the best investment choices for plan participants. The importance of diversification. Robbins highlights the importance of diversification in building a retirement portfolio. While 401k plans often limit investment options to a handful of mutual funds, he argues that a truly diversified portfolio should include a mix of asset classes, such as stocks, bonds, real estate, and alternative investments. He advises readers to consider supplementing their 401k savings with other investment vehicles, such as IRAs, Roth IRAs, and taxable investment accounts, which may offer a broader range of investment options and greater flexibility. By diversifying across different asset classes and investment vehicles, you can reduce risk and increase the potential for long-term growth. The value of employer matching contributions. One of the key benefits of 401k plans that Robbins acknowledges is the potential for employer matching contributions. Many employers offer to match a portion of the contributions made by employees to their 401k plans, effectively providing free money that can significantly boost retirement savings. Robbins strongly encourages readers to take full advantage of employer matching contributions by contributing at least enough to their 401k to receive the full match. He emphasizes that failing to do so is equivalent to leaving money on the table and can result in a significant loss of potential wealth over time. The need for a comprehensive retirement strategy. While 401k plans can be an important part of retirement savings, Robbins argues that they should not be the sole focus of your retirement strategy. He emphasizes the need for a comprehensive approach that includes other savings vehicles, tax planning, and a well-diversified investment portfolio. Robbins encourages readers to consider factors such as inflation, longevity, and healthcare costs when planning for retirement. He also discusses the importance of having a clear retirement income strategy, which may include sources of income such as Social Security, pensions, annuities, and investment income. Chapter 2.6. Myth 6: Target date funds, just set it and forget it. In this chapter, Robbins addresses the myth that target date funds are a foolproof, hands-off investment solution for retirement planning. Target date funds are often marketed as a simple way to invest for retirement by automatically adjusting the asset allocation as you approach your target retirement date. While these funds can offer convenience, Robbins argues that they are not without their drawbacks and may not be the best choice for all investors. What are target date funds? Robbins begins by explaining what target date funds are and how they work. Target date funds are mutual funds that automatically adjust their asset allocation based on a specific target retirement date, typically becoming more conservative as the date approaches. For example, a target date fund with a retirement date of 2040 would start with a higher allocation to stocks in the early years and gradually shift to bonds and other fixed income assets as 2040 nears. These funds are often promoted as a set it and forget it solution for retirement investing, appealing to individuals who want a hands-off approach. The idea is that the fund will automatically manage the risk for you, reducing the need for ongoing monitoring and rebalancing. The drawbacks of target date funds. While target date funds offer convenience, Robbins highlights several drawbacks that investors should be aware of. One of the primary concerns is that the asset allocation within target date funds may not align with your individual risk tolerance, financial goals, or retirement needs. Because these funds use a one-size-fits-all approach, they may be too conservative or too aggressive for some investors, particularly as they near retirement. Robbins also points out that target date funds often come with higher fees compared to other investment options, such as index funds or ETFs. These fees can include management fees, administrative costs, and expense ratios that can eat into your investment returns over time. Given the long-term nature of retirement investing, even small differences in fees can have a significant impact on your overall wealth. Another issue Robbins discusses is the variability in performance among different target date funds. Not all target date funds are created equal, and the performance can vary widely depending on the fund manager, the underlying assets, and the fund's glide path, the rate at which the asset allocation shifts over time. This variability means that some target date funds may not provide the returns or risk management that investors expect. The problem with glide paths. Robbins delves into the concept of a glide path, which is the schedule that determines how a target date fund's asset allocation shifts over time. He explains that different target date funds have different glide paths, and these paths can significantly affect the fund's performance and risk profile. For example, some target date funds may shift to a more conservative allocation earlier than others, potentially sacrificing growth in exchange for reduced volatility. On the other hand, some funds may remain heavily invested in stocks closer to the target retirement date, increasing the risk of significant losses if the market declines. Robbins emphasizes that the glide path of a target date fund may not align with your personal retirement goals or risk tolerance. He encourages readers to carefully review the glide path of any target date fund they are considering and to assess whether it meets their individual needs. The importance of personalization. Robbins argues that one of the key limitations of target date funds is their lack of personalization. While these funds are designed to be a one-size-fits-all solution, every investor's financial situation, goals, and risk tolerance are unique. Robbins suggests that a more personalized approach to retirement planning, which takes into account your specific circumstances, may be more effective. He advises readers to consider working with a financial advisor who can help create a customized retirement plan that aligns with their goals and risk tolerance. This plan may include a mix of different asset classes, investment vehicles, and strategies that are tailored to your individual needs, rather than relying solely on a target date fund. Alternatives to target date funds. Robbins offers several alternatives to target date funds that investors may want to consider. One option is to build a diversified portfolio using low-cost index funds or ETFs, which can provide broad market exposure at a lower cost. By managing your asset allocation and rebalancing periodically, you can create a portfolio that aligns with your risk tolerance and retirement goals. Another alternative Robbins discusses is the use of managed accounts, where a professional advisor or robo-advisor manages your investments based on your specific financial situation and goals. Managed accounts can offer the convenience of professional management, while providing a more personalized approach than target date funds. By taking a more proactive and personalized approach to retirement planning, Robbins argues that investors can better achieve their financial goals and secure a comfortable retirement. He emphasizes the importance of understanding the true costs and risks associated with target date funds and making informed decisions about your retirement investments. Chapter 2.7. Myth 7. I hate annuities, and you should too. This chapter tackles the widespread disdain for annuities, a type of financial product often criticized for being complex, expensive, and not worth the investment. Robbins acknowledges the negative perception surrounding annuities but argues that, when used correctly, they can be a valuable tool for securing guaranteed income in retirement. He seeks to demystify annuities and provide a balanced perspective on their potential benefits and drawbacks. Understanding annuities. Robbins begins by explaining what annuities are and how they work. An annuity is a contract between an individual and an insurance company, where the individual makes a lump sum payment, or a series of payments, and in return, the insurance company agrees to make periodic payments to the individual, either immediately or at some point in the future. Annuities are designed to provide a steady income stream, often for the rest of the individual's life, making them a popular option for retirees seeking financial security. There are several types of annuities, each with its own characteristics and benefits. Fixed annuities. These provide a guaranteed, fixed interest rate on the contributions, leading to predictable payments. Variable annuities. These allow the annuity holder to invest in various subaccounts, similar to mutual funds, with the payments fluctuating based on the performance of those investments. Indexed annuities. These are tied to the performance of a stock market index, like the S&P 500, offering the potential for higher returns while still providing some level of principal protection. Robbins emphasizes that the key to understanding annuities is recognizing their dual nature as both an investment product and an insurance product. This dual nature is what makes them complex and often misunderstood. The pros and cons of annuities. Robbins provides a balanced view of the pros and cons of annuities. On the positive side, annuities offer several benefits that can be particularly valuable in retirement. Guaranteed income. One of the most attractive features of annuities is the promise of guaranteed income for life, which can provide peace of mind for retirees worried about outliving their savings. Tax deferral. Contributions to annuities grow tax deferred, meaning you don't pay taxes on the earnings until you withdraw the money. This can be advantageous for long-term growth. Principal protection. Some types of annuities, such as fixed and indexed annuities, offer protection against market losses, ensuring that the principal is not at risk. However, Robbins also highlights the drawbacks associated with annuities. High fees. Annuities often come with higher fees compared to other investment products. These fees can include management fees, surrender charges, and mortality and expense charges, which can significantly reduce the overall return on investment. Complexity. Annuities are complex financial products, with many different options and features that can be confusing to understand. This complexity can make it difficult for investors to fully comprehend what they are buying. Limited liquidity. Annuities are generally illiquid, meaning that it can be difficult or costly to access your money if you need it before the annuity term ends. Early withdrawals often incur substantial penalties. The misconceptions about annuities. Robbins discusses the common misconceptions about annuities that contribute to their negative reputation. One of the biggest misconceptions is that all annuities are bad investments because of their high fees and complexity. Robbins counters this by explaining that not all annuities are created equal, and some may be more appropriate for certain individuals depending on their financial goals and needs. Another misconception is that annuities are only for risk-averse individuals who want to avoid market volatility. While it's true that some annuities, like fixed annuities, are designed for conservative investors, Robbins points out that other types, such as variable and indexed annuities, offer the potential for higher returns and can be suitable for those willing to accept more risk in exchange for growth opportunities. When annuities make sense. Robbins explains that annuities can be a valuable part of a diversified retirement plan, especially for individuals who prioritize security and guaranteed income. He suggests that annuities may be particularly beneficial for those who want guaranteed income for life. For retirees who are concerned about outliving their savings, annuities can provide a reliable income stream that lasts as long as they do. Seek principal protection. Individuals who are risk-averse and want to protect their principal from market downturns may find fixed or indexed annuities appealing. Prefer tax-deferred growth. For those who want to maximize the growth of their investments on a tax-deferred basis, annuities can offer an additional tax-advantaged savings option, especially if they have maxed out contributions to other retirement accounts like IRAs or 401(k)s. Robbins advises that annuities should not be the sole component of a retirement plan but rather one piece of a larger strategy. He emphasizes the importance of understanding the terms and conditions of any annuity product before purchasing and recommends working with a financial advisor who is knowledgeable about annuities and can help determine if they are suitable for your specific situation. Finding the right annuity. To help readers navigate the complex world of annuities, Robbins provides guidance on how to choose the right annuity. He suggests considering the following factors. Cost. Look for annuities with low fees and transparent pricing structures. High fees can significantly reduce your overall returns, so it's crucial to understand all the costs associated with the annuity. Issuer's credit rating. Since annuities are backed by insurance companies, it's important to choose a product from a company with a strong credit rating to ensure that the company will be able to meet its payment obligations. Contract terms. Carefully review the terms of the annuity contract, including surrender charges, withdrawal provisions, and payout options. Make sure the terms align with your financial goals and needs. Customization. Consider whether the annuity allows for customization, such as choosing a payout schedule that matches your income needs or adding riders that provide additional benefits, like long-term care coverage. The chapter concludes with the reminder that understanding and carefully selecting financial products, including annuities, is key to achieving long-term financial success. Chapter 2.8. Myth 8. You gotta take huge risks to get big rewards. In this chapter, Robbins debunks the myth that achieving significant financial rewards requires taking on huge risks. This misconception often leads investors to believe that they must engage in high-risk investments to achieve high returns. Robbins argues that while risk and reward are related, it is possible to achieve substantial financial success without exposing yourself to excessive risk. He introduces the concept of asymmetric risk-reward, where the potential upside of an investment greatly outweighs the downside. The relationship between risk and reward. Robbins begins by discussing the traditional view that risk and reward are directly correlated. The higher the risk, the higher the potential reward. While this is true to some extent, Robbins explains that it does not mean investors should automatically seek out high-risk opportunities. Instead, he emphasizes the importance of managing risk and seeking investments that offer a favorable balance between risk and reward. He argues that the key to successful investing is not necessarily taking on more risk but rather identifying opportunities where the potential reward is significantly greater than the risk. This approach allows investors to protect their capital while still achieving substantial returns. The concept of asymmetric risk-reward. Robbins introduces the concept of asymmetric risk-reward, which involves finding investments where the potential upside is much greater than the downside risk. In other words, these are opportunities where the reward significantly outweighs the risk, offering the potential for substantial gains with limited exposure to loss. Robbins shares examples of successful investors who have mastered the art of asymmetric risk-reward, such as Warren Buffett and Paul Tudor Jones. These investors have built their fortunes by carefully analyzing opportunities and investing only when the odds are heavily in their favor. By focusing on asymmetric risk-reward, they have been able to achieve high returns without taking on excessive risk. The power of compounding. Robbins emphasizes the importance of compounding as a key factor in building wealth without taking on unnecessary risk. Compounding allows your investments to grow exponentially over time, as the returns on your investments generate their own returns. This powerful concept enables investors to achieve substantial wealth by consistently earning moderate returns rather than taking on high-risk investments. He explains that by avoiding significant losses and allowing your investments to compound over time, you can achieve financial success with relatively low risk. Robbins encourages readers to focus on long-term growth and to avoid the temptation to chase after high-risk, high-reward opportunities that could lead to significant losses. The role of diversification. Diversification is another critical element of managing risk while seeking high returns. Robbins explains that diversification involves spreading your investments across different asset classes, industries, and geographic regions to reduce the overall risk of your portfolio. By diversifying, you can protect your investments from the volatility of any single market or sector and increase the likelihood of achieving consistent returns. Robbins advises readers to diversify their portfolios by including a mix of stocks, bonds, real estate, and other assets. He also suggests considering alternative investments, such as hedge funds or private equity, which can provide additional diversification and potential for asymmetric risk-reward. Risk management strategies. Robbins discusses several risk management strategies that can help investors protect their capital while still achieving high returns. One such strategy is the use of stop-loss orders, which automatically sell an investment if its price falls below a certain level. This can help limit losses in the event of a market downturn. Another strategy Robbins highlights is hedging, which involves using financial instruments like options or futures to offset potential losses in your portfolio. Hedging can provide a layer of protection against market volatility and reduce the overall risk of your investments. Robbins also emphasizes the importance of maintaining a long-term perspective and avoiding emotional decision-making. He advises readers to stick to their investment plans and not to be swayed by short-term market fluctuations or the fear of missing out on high-risk opportunities. The value of patience and discipline. Patience and discipline are key virtues in successful investing, according to Robbins. He explains that building wealth is a gradual process that requires consistent effort and a long-term perspective. By avoiding impulsive decisions and focusing on steady, compounding growth, investors can achieve significant financial success without taking on excessive risk. Robbins encourages readers to stay committed to their investment strategies and to resist the urge to chase after high-risk opportunities that promise quick riches. He emphasizes that true wealth is built over time through disciplined investing, not by taking unnecessary risks. By debunking this myth, Robbins empowers readers to approach investing with a mindset that prioritizes smart risk management and steady growth. He encourages them to seek out opportunities where the potential reward far outweighs the risk, allowing them to build wealth while protecting their capital. Chapter 2.9 Myth 9: The Lies We Tell Ourselves. This chapter delves into the psychological barriers and self-deceptions that prevent people from achieving financial success. Robbins argues that the most dangerous myths are those we create in our own minds, beliefs that limit our potential and keep us from taking the necessary steps to secure our financial future. The power of beliefs. Robbins begins by discussing the power of beliefs in shaping our financial reality. He explains that our beliefs about money, wealth, and success are often formed early in life and can have a profound impact on our financial behavior. These beliefs can either empower us to take action and achieve our goals, or they can hold us back by creating fear, doubt, and inaction. One of the most common self-limiting beliefs is the idea that I'm not good with money, or I'm not a financial person. Robbins argues that these beliefs are not inherent truths but learned behaviors that can be changed. By challenging and reframing these beliefs, individuals can develop the confidence and skills needed to take control of their financial lives. The fear of failure. Another common lie people tell themselves is the fear of failure. Many individuals are afraid to invest or take financial risks because they worry about losing money or making mistakes. Robbins explains that this fear can be paralyzing, leading to inaction and missed opportunities. He emphasizes that failure is a natural part of the learning process, and that every successful investor has experienced setbacks along the way. Robbins encourages readers to reframe their fear of failure as a learning opportunity. He suggests that instead of fearing mistakes, individuals should embrace them as valuable experiences that can lead to growth and improvement. By adopting a mindset that views failure as a stepping stone to success, readers can overcome their fears and take proactive steps toward financial freedom. The excuses we make. Robbins also discusses the excuses people make to avoid taking responsibility for their financial future. Common excuses include, I don't have enough time, I don't have enough money to invest, or I'll start saving when I make more money. Robbins argues that these excuses are simply ways of avoiding the discomfort of change and the effort required to achieve financial success. He emphasizes that there is never a perfect time to start investing or saving. The key is to start now, regardless of your current circumstances. Robbins suggests that even small, consistent actions can lead to significant financial progress over time. By eliminating excuses and taking responsibility for your financial future, you can begin to build the habits and mindset needed for long-term success. The myth of scarcity. The myth of scarcity is another lie that holds people back from achieving wealth. This belief is rooted in the idea that there is a limited amount of wealth and opportunity in the world, leading to a mindset of competition and fear. Robbins explains that the myth of scarcity can create a sense of lack and anxiety, preventing individuals from taking the risks and actions necessary to build wealth. Robbins challenges this belief by introducing the concept of abundance. He argues that wealth and opportunity are not finite resources but can be created and expanded. By adopting an abundance mindset, individuals can shift their focus from what they lack to what they can create, leading to greater confidence and motivation to pursue financial goals. Overcoming limiting beliefs. Robbins provides practical strategies for overcoming the limiting beliefs that hold us back. He suggests starting by identifying the specific beliefs that are preventing you from taking action. Once these beliefs are identified, Robbins recommends challenging them by asking yourself whether they are truly based on facts, or if they are simply assumptions or fears. He also encourages readers to replace limiting beliefs with empowering ones. For example, instead of believing, I'm not good with money, you could adopt the belief, I'm learning to manage my money effectively. By consistently reinforcing positive beliefs, you can gradually change your mindset and develop the confidence needed to take control of your financial future. The importance of action. Throughout the chapter, Robbins emphasizes the importance of taking action. He argues that the biggest lie we tell ourselves is that we have time to wait, or that we can start later. Robbins stresses that time is our most valuable asset, and the sooner we begin taking steps toward financial freedom, the better off we will be. He encourages readers to start small, whether it's by setting up an automatic savings plan, investing in a low-cost index fund, or educating themselves about personal finance. The key is to take consistent action, no matter how small, and to build momentum over time. This chapter serves as a powerful reminder that the most significant obstacles to financial success are often the ones we create in our own minds. By changing our beliefs and taking proactive steps, we can unlock our full potential and build the wealth and security we desire. Chapter 3.0 What's the price of your dreams? Make the game winnable. In Chapter 3.0, Tony Robbins shifts focus from debunking myths to helping readers define their financial goals and create a clear, actionable plan to achieve them. This chapter is about making your financial journey both practical and achievable by understanding what you truly want and breaking it down into manageable steps. Robbins introduces the concept of making the game of financial freedom winnable by setting realistic and specific targets. Defining financial freedom. Robbins begins by asking readers to reflect on what financial freedom means to them personally. He emphasizes that financial freedom is not a one-size-fits-all concept. It varies from person to person based on their lifestyle, values, and aspirations. For some, financial freedom might mean the ability to retire early and travel the world, while for others, it could mean simply having enough money to cover basic needs without worry. Robbins suggests that the first step toward financial freedom is defining what it looks like for you. He encourages readers to envision their ideal life and consider how much money they would need to achieve it. This involves calculating the cost of your desired lifestyle, including everyday expenses, travel, hobbies, and any other goals you may have. The power of clarity. Once you have a clear vision of what financial freedom means to you, Robbins explains the importance of setting specific, measurable financial goals. He argues that vague goals like, "I want to be rich," are not helpful because they lack clarity and focus. Instead, Robbins advocates for setting precise goals with a clear timeline, such as, "I want to save $500,000 by the time I'm 50," or, "I want to generate $100,000 in passive income per year within the next 10 years. Robbins emphasizes that clarity is power. The more specific and detailed your financial goals are, the easier it will be to create a plan to achieve them. He encourages readers to break down their long-term goals into smaller, more manageable milestones that can be achieved over time. The 5 levels of financial freedom. Robbins introduces the concept of the 5 levels of financial freedom, which provides a framework for setting financial goals and tracking progress. These levels represent different stages of financial security and independence, each with its own financial benchmarks. 1. Financial security. The first level is about covering your basic needs, such as housing, food, utilities, and transportation. Robbins suggests calculating the total monthly cost of these essentials and then setting a goal to generate enough income to cover them without relying on your job. 2. Financial vitality. The second level goes beyond basic needs to include a more comfortable lifestyle. This might involve covering discretionary expenses like dining out, entertainment, and modest travel. The goal is to have enough income to cover both essentials and some extras. 3. Financial independence. At this level, you aim to cover all your current living expenses without having to work. This includes everything from housing and food to entertainment, travel, and hobbies. The focus is on building a passive income stream that fully supports your desired lifestyle. 4. Financial freedom. Financial freedom is achieved when you can afford your ideal lifestyle without worrying about money. This level includes not only covering all your expenses but also having enough to pursue your passions, give to charity, and enjoy life without financial stress. 5. Absolute financial freedom. The final level represents the ultimate financial goal, where you have more than enough money to do whatever you want, whenever you want, without any financial constraints. This might include luxuries like owning multiple homes, traveling first class, or funding large philanthropic endeavors. Robbins encourages readers to assess which level of financial freedom they are currently at and to set specific goals for reaching the next level. By breaking down the journey into these stages, the path to financial freedom becomes more manageable and less overwhelming. Calculating your number. A key part of making the game winnable is calculating your number, the amount of money you need to achieve each level of financial freedom. Robbins provides a step-by-step guide to calculating these figures, starting with estimating your monthly and annual expenses for each level. He then explains how to convert these expenses into a total freedom fund by determining the amount of savings and investments needed to generate the required income. For example, if you need $60,000 per year to cover your expenses at the financial independence level, and you can expect a 5% return on your investments, you would need a freedom fund of $1. $2,060,000 divided by 0.05 equals $1,200,000. Robbins emphasizes the importance of being realistic in your calculations and considering factors like inflation, taxes, and longevity. Making the plan realistic. Robbins stresses that the plan to achieve financial freedom should be both ambitious and realistic. He advises against setting goals that are too lofty or unattainable, as this can lead to frustration and discouragement. Instead, he encourages readers to focus on consistent progress, celebrating small victories along the way. He also discusses the importance of flexibility in your financial plan. Life is unpredictable, and circumstances can change, so it's important to regularly review and adjust your goals and strategies as needed. Robbins suggests setting up regular check-ins to assess your progress and make any necessary adjustments to stay on track. Taking action. The final part of the chapter focuses on taking action. Robbins emphasizes that no matter how well you plan, nothing will change unless you take concrete steps toward your goals. He encourages readers to start small, whether it's by setting up an automatic savings plan, investing in a diversified portfolio, or seeking out additional income streams. The key is to build momentum and keep moving forward. Robbins also highlights the importance of persistence and resilience. The journey to financial freedom is not always smooth, and there will likely be setbacks along the way. However, by staying committed to your goals and maintaining a positive attitude, you can overcome obstacles and continue making progress. Chapter 3.1 What's your plan? Why the future is better than you think. In this chapter, Tony builds on the concept of making the game winnable by discussing the importance of having a solid, actionable financial plan. He emphasizes that while the future might seem uncertain or intimidating, it's actually full of opportunities for those who are prepared. Robbins argues that a well-thought-out plan not only provides a roadmap to financial freedom but also instills confidence and peace of mind, enabling you to navigate the challenges and changes that lie ahead. The importance of planning. Robbins starts by stressing that having a plan is essential to achieving any significant goal, especially financial freedom. He compares the process of financial planning to setting out on a journey. Without a clear destination and a map to guide you, you're likely to get lost or go in circles. A plan provides direction, helps you make informed decisions, and allows you to measure progress over time. He also highlights that while many people have vague aspirations of financial security or wealth, few take the time to actually plan how they will achieve these goals. Robbins argues that this lack of planning is one of the primary reasons why so many people struggle with their finances. By creating a detailed, actionable plan, you take control of your financial future and increase your chances of success. Why the future is brighter than you think. Robbins counters the common narrative of economic doom and gloom by explaining why he believes the future is actually full of potential. He acknowledges that the media often focuses on negative news, creating a sense of fear and uncertainty about the future. However, Robbins argues that this perspective is not only unproductive but also misleading. He points out that throughout history, periods of rapid technological advancement and economic growth have often followed times of crisis. He cites examples of technological innovations, scientific discoveries, and economic trends that have dramatically improved living standards and created new opportunities for wealth creation. Robbins encourages readers to adopt an optimistic mindset and to focus on the opportunities that lie ahead rather than the challenges. The power of compound growth. A key theme in this chapter is the power of compound growth and how it can transform your financial situation over time. Robbins explains that even modest investments, when allowed to grow over several decades, can result in significant wealth due to the effects of compounding. He uses examples to illustrate how consistent investing, combined with the power of compound interest, can lead to exponential growth in your financial assets. Robbins emphasizes that the sooner you start investing, the more time you have to benefit from compounding. He encourages readers to begin investing as early as possible, even if they can only start with small amounts. The key is consistency and time, which together can turn even modest savings into substantial wealth. Creating a personal financial plan. Robbins outlines the key components of a personal financial plan, emphasizing that it should be tailored to your individual circumstances, goals, and risk tolerance. He suggests starting by clearly defining your financial goals, such as saving for retirement, buying a home, or funding your children's education. Once you have a clear understanding of what you want to achieve, you can begin to create a plan to reach those goals. He advises breaking down your financial goals into short-term, medium-term, and long-term objectives, and then developing a strategy for each. For example, your short-term goals might include building an emergency fund and paying off high-interest debt, while your long-term goals might focus on retirement savings and wealth accumulation. Robbins also emphasizes the importance of budgeting and living within your means. He suggests tracking your expenses to identify areas where you can cut back and redirect those savings toward your financial goals. By maintaining a disciplined approach to spending and saving, you can accelerate your progress and achieve financial freedom more quickly. The role of diversification. Diversification is another key component of a solid financial plan, according to Robbins. He explains that diversification involves spreading your investments across different asset classes, industries, and geographic regions to reduce risk and increase the potential for steady returns. By diversifying your portfolio, you can protect yourself from the volatility of any single market or sector and improve your chances of long-term success. Robbins advises readers to consider a mix of stocks, bonds, real estate, and other assets in their portfolios, based on their risk tolerance and financial goals. He also suggests regularly reviewing and rebalancing your portfolio to ensure that it remains aligned with your objectives and risk profile. Staying flexible and adapting to change. Robbins stresses that while it's important to have a plan, it's equally important to remain flexible and adaptable. The world is constantly changing, and your financial plan should be able to evolve in response to new information, opportunities, and challenges. Robbins advises regularly reviewing your plan and making adjustments as needed to stay on track. He also discusses the importance of staying informed about economic trends, market conditions, and new investment opportunities. By continually educating yourself and being open to new ideas, you can take advantage of opportunities as they arise and avoid being caught off guard by unexpected events. Taking action and staying committed. The chapter concludes with a call to action. Robbins emphasizes that the most important step in achieving financial freedom is taking action. He encourages readers to start implementing their financial plan immediately, even if it's just small steps at first. The key is to build momentum and stay committed to your goals. Robbins also highlights the importance of perseverance. The journey to financial freedom is not always easy, and there will be setbacks along the way. However, by staying focused on your goals and continuing to take action, you can overcome obstacles and achieve the financial security and independence you desire. Chapter 3.2 Speed It Up: 3 Keys to Accelerating Your Financial Freedom. This chapter introduces 3 key strategies to accelerate the journey to financial freedom. While the previous chapters focused on building a solid foundation, this chapter is about maximizing your efforts and speeding up the process of wealth creation. Robbins shares practical tips and techniques that can help you achieve your financial goals faster, allowing you to enjoy the benefits of financial freedom sooner. Key 1. Save more and invest the difference. The first key to accelerating your financial freedom is to increase your savings rate and invest the difference. Robbins explains that the more you can save and invest, the faster your wealth will grow. He emphasizes that small changes in your spending habits can have a significant impact on your financial future, especially when those savings are invested and allowed to compound over time. Robbins suggests conducting a thorough review of your expenses to identify areas where you can cut back. This might include reducing discretionary spending, eliminating unnecessary subscriptions, or finding more cost-effective alternatives for everyday expenses. By freeing up more money to invest, you can increase the rate at which your wealth grows and reach your financial goals more quickly. He also advises setting up automatic transfers to your investment accounts, so that a portion of your income is consistently invested each month. This pay yourself first strategy ensures that saving and investing become a priority, rather than something that happens only if there's money left over at the end of the month. Key 2. earn more, and accelerate your income. The second key to speeding up your financial freedom is to focus on increasing your income. Robbins argues that while saving and investing are crucial, earning more money can have an even greater impact on your ability to build wealth. He encourages readers to explore opportunities to boost their income, whether through advancing in their careers, starting a side business, or investing in income-generating assets. Robbins suggests several strategies for increasing your income: career advancement, invest in your education and skills to increase your value in the job market, seek out promotions, negotiate higher salaries, or explore new career opportunities that offer better compensation. Side hustles, consider starting a side business or taking on freelance work to generate additional income. This could be anything from offering consulting services to creating an online business. Invest in income-generating assets. Focus on investments that provide regular income, such as dividend-paying stocks, rental properties, or bonds. These assets can provide a steady stream of cash flow, which can be reinvested to accelerate your wealth-building efforts. Robbins emphasizes that the key to increasing your income is to leverage your unique skills, talents, and passions. By focusing on areas where you excel and enjoy working, you can create additional income streams that not only boost your wealth but also bring personal fulfillment. Key 3. Improve your investment returns. The third key to accelerating your financial freedom is to maximize the returns on your investments. Robbins explains that even small improvements in your investment returns can have a significant impact on your wealth over time, especially when compounded over several decades. He offers several strategies for improving your investment performance. Lower your fees. Reduce the fees associated with your investments by choosing low-cost index funds or ETFs over actively managed mutual funds. High fees can eat into your returns, so minimizing them is crucial for maximizing your investment growth. Optimize your asset allocation. Ensure that your investment portfolio is well diversified and aligned with your risk tolerance and financial goals. Regularly review and rebalance your portfolio to maintain the optimal mix of assets. Seek out asymmetric risk-reward opportunities. Focus on investments where the potential upside significantly outweighs the downside risk. Robbins highlights that finding these asymmetric opportunities can boost your returns without exposing you to excessive risk. Tax efficiency. Maximize the tax efficiency of your investments by using tax-advantaged accounts like IRAs, Roth IRAs, and 401(k)s. Reducing the tax drag on your investments can improve your net returns and accelerate your wealth-building efforts. Robbins also encourages readers to continuously educate themselves about investing and to stay informed about market trends and opportunities. By becoming a more knowledgeable and disciplined investor, you can improve your decision-making and achieve better returns on your investments. The power of compounding your efforts. A recurring theme in this chapter is the power of compounding, not just in your investments, but in your overall financial efforts. Robbins explains that by consistently saving more, earning more, and improving your investment returns, you can create a compounding effect that accelerates your journey to financial freedom. Each improvement you make builds on the last, leading to exponential growth in your wealth over time. He emphasizes that while none of these strategies are quick fixes, they are proven methods for building wealth more quickly and effectively. The key is to remain focused, disciplined, and committed to your financial goals, even when progress seems slow. Staying motivated and focused. Robbins acknowledges that the journey to financial freedom can be challenging and that it's easy to lose motivation along the way. He advises readers to stay focused on their goals by regularly reviewing their progress and celebrating small victories. He also suggests surrounding yourself with supportive and like-minded individuals who can encourage and motivate you to stay on track. He encourages readers to visualize the life they want to achieve and to keep that vision in mind as they work toward their goals. By staying focused on the bigger picture and the rewards that financial freedom will bring, you can maintain the motivation and discipline needed to accelerate your progress. Chapter 3.3 It's Time to Thrive, Stormproof Returns and Unrivaled Results. In this chapter, Robbins discusses how to achieve stormproof returns, investment strategies that can withstand market volatility and economic downturns. He emphasizes the importance of building a resilient investment portfolio that not only survives but thrives in various market conditions. Robbins shares insights from some of the world's top investors on how to achieve consistent, unrivaled results by focusing on risk management, diversification, and a long-term perspective. The importance of risk management. Robbins begins by highlighting the critical role that risk management plays in achieving long-term investment success. He explains that while many investors focus solely on maximizing returns, the most successful investors prioritize protecting their capital and minimizing losses. Robbins argues that managing risk effectively is the key to building wealth that can withstand economic storms and market fluctuations. He introduces the concept of asymmetric risk-reward, where the potential upside of an investment significantly outweighs the downside risk. Robbins emphasizes that by focusing on investments with favorable risk-reward profiles, you can achieve consistent returns while minimizing the risk of significant losses. The all-weather portfolio. One of the key strategies Robbins discusses in this chapter is the all-weather portfolio, a diversified investment strategy designed to perform well in all market conditions. The all-weather portfolio was popularized by Ray Dalio, one of the world's most successful hedge fund managers. Dalio's approach is based on the idea that by diversifying across different asset classes that respond differently to various economic environments, you can create a portfolio that is resilient to market volatility. Robbins outlines the key components of the all-weather portfolio, which typically includes a mix of stocks, for growth potential during economic expansions, bonds, for stability and income during economic downturns, commodities, for protection against inflation, gold, as a hedge against currency devaluation and geopolitical risk. Robbins explains that the exact allocation of these assets can vary depending on your risk tolerance and financial goals, but the overall goal is to create a portfolio that can weather any economic storm. He emphasizes that the all-weather portfolio is not about chasing the highest returns but about achieving consistent, reliable results over the long term. Diversification across economic environments. Robbins discusses the importance of diversifying not just across asset classes, but also across different economic environments. He explains that the economy goes through various phases, such as periods of growth, recession, inflation, and deflation, and that different asset classes perform differently in each of these environments. By diversifying your investments across assets that thrive in different economic conditions, you can reduce the overall risk of your portfolio and improve its resilience. Robbins encourages readers to consider how their investments will perform in different scenarios and to build a portfolio that is well balanced and prepared for any economic environment. The power of rebalancing. Another important concept Robbins introduces is the power of rebalancing. Rebalancing involves periodically adjusting your portfolio to maintain your desired asset allocation. For example, if the stock market performs well and your stock holdings grow to represent a larger portion of your portfolio, you may need to sell some stocks and buy more bonds or other assets to restore your original allocation. Robbins explains that rebalancing is crucial for maintaining the risk-reward profile of your portfolio and for ensuring that you are not overexposed to any single asset class. He advises readers to establish a regular rebalancing schedule, such as annually or semi-annually, and to stick to it regardless of market conditions. The value of long-term thinking. Throughout the chapter, Robbins emphasizes the importance of maintaining a long-term perspective when investing. He argues that short-term market fluctuations are inevitable, and that successful investors are those who remain focused on their long-term goals rather than reacting to short-term noise. Robbins encourages readers to avoid the temptation to time the market or make impulsive decisions based on fear or greed. Instead, he advises sticking to a well-thought-out investment strategy, like the all-weather portfolio, that is designed to perform well over time. He also discusses the importance of patience and discipline in achieving consistent investment results. By staying committed to your investment plan and resisting the urge to chase after quick profits, you can build a resilient portfolio that delivers strong, long-term returns. Learning from the best. Robbins shares insights from some of the world's most successful investors, including Ray Dalio, Warren Buffett, and Jack Bogle, on how to achieve unrivaled investment results. He emphasizes that these investors have achieved success not by taking excessive risks but by focusing on risk management, diversification, and long-term thinking. He highlights the common principles that these investors share, such as the importance of protecting capital, avoiding unnecessary complexity, and maintaining a disciplined approach. Robbins encourages readers to study the strategies of successful investors and to apply those principles to their own investment plans. By adopting these principles and staying focused on your long-term goals, Robbins argues that you can build a portfolio that not only survives but thrives in any economic environment, helping you achieve financial freedom with confidence. Chapter 3.4: Your Money Machine, Your Lifetime Income Plan. This chapter introduces the concept of building a money machine, a lifetime income plan designed to provide you with financial security and independence for the rest of your life. Robbins emphasizes that the ultimate goal of financial freedom is not just accumulating wealth but creating a reliable income stream that can support your desired lifestyle indefinitely. This chapter focuses on the strategies and tools you can use to build a sustainable income plan that will last throughout your retirement years and beyond. The importance of lifetime income. Robbins begins by explaining that one of the biggest fears people have about retirement is outliving their money. He argues that financial freedom is not just about having a large sum of money saved, it's about having a consistent, predictable income stream that can cover your expenses for the rest of your life. This income should be sufficient to maintain your desired lifestyle, regardless of market conditions or economic fluctuations. Robbins introduces the idea of a money machine as a metaphor for a well-constructed financial plan that generates income reliably and sustainably. He emphasizes that the key to building a successful money machine is to focus on creating multiple streams of income that are diversified and resilient. Building your money machine. Robbins outlines several key components of a successful money machine. 1. Income-producing investments. These are investments that generate regular income, such as dividend-paying stocks, bonds, and real estate. Robbins explains that the goal is to create a portfolio of income-producing assets that can provide a steady stream of cash flow, even during market downturns. 2. Social Security. Robbins discusses the importance of maximizing your Social Security benefits as part of your lifetime income plan. He provides tips on how to optimize your Social Security benefits, such as delaying benefits to increase your monthly payments and coordinating benefits with your spouse. 3. Pensions and annuities. For those who have access to pensions or are considering annuities, Robbins explains how these can provide a reliable source of lifetime income. He discusses the pros and cons of annuities and offers guidance on how to choose the right type of annuity for your needs. 4. Rental income. Robbins highlights rental income from real estate as another potential source of lifetime income. He explains that investing in rental properties can provide a steady stream of cash flow, as well as the potential for property appreciation over time. 5. Business income. For those who own a business, Robbins discusses how business income can be a significant component of your money machine. He emphasizes the importance of building a business that can generate passive income, even if you are no longer actively involved in its day-to-day operations. The role of asset allocation. Asset allocation plays a crucial role in building a sustainable money machine. Robbins explains that the right mix of assets can help you achieve a balance between income generation and capital preservation. He advises readers to diversify their income-producing investments across different asset classes, such as stocks, bonds, real estate, and alternative investments. Robbins also discusses the importance of rebalancing your portfolio regularly to ensure that it remains aligned with your income goals and risk tolerance. By maintaining a diversified and well-balanced portfolio, you can reduce the risk of significant losses and increase the stability of your income stream. Creating a withdrawal strategy. A key component of your lifetime income plan is developing a withdrawal strategy that ensures your money lasts as long as you do. Robbins explains that one of the biggest challenges in retirement is determining how much you can withdraw from your savings each year without running out of money. He introduces the concept of the 4% rule, a commonly used guideline that suggests withdrawing 4% of your retirement savings each year to provide a steady income while preserving your principal. However, Robbins cautions that this rule may not be appropriate for everyone, especially in today's low-interest rate environment. He encourages readers to work with a financial advisor to develop a personalized withdrawal strategy that takes into account factors like inflation, market volatility, and life expectancy. Protecting against longevity risk. Longevity risk, the risk of outliving your money, is a significant concern for many retirees. Robbins discusses strategies for protecting against this risk, such as purchasing longevity insurance or annuities that provide lifetime income. He also emphasizes the importance of planning for healthcare costs, which can be a major expense in retirement. Robbins advises readers to consider long-term care insurance as a way to protect their assets from the high costs of long-term care. He also suggests setting aside a portion of your retirement savings in a separate account to cover healthcare expenses, ensuring that you have the resources to maintain your health and well-being throughout your retirement years. The importance of flexibility. Flexibility is another key component of a successful lifetime income plan. Robbins emphasizes that life is unpredictable, and your financial plan should be able to adapt to changes in your circumstances, such as unexpected expenses, market downturns, or changes in your health. He encourages readers to regularly review and update their income plan to ensure that it remains aligned with their goals and needs. By staying flexible and being willing to make adjustments as needed, you can increase the resilience of your money machine and protect your financial security. Chapter 4.0 The Dream Team, Your Wealth Building Power Team. In this chapter, Robbins shifts focus to the importance of building a dream team, a group of trusted advisors and professionals who can help you achieve your financial goals. Robbins emphasizes that financial success is not a solo journey. It requires the support and expertise of a team of skilled individuals who can provide guidance, advice, and resources. This chapter explores the roles of various financial professionals and offers tips on how to assemble a team that can help you build and protect your wealth. The power of a team. Robbins begins by explaining that even the most successful investors and entrepreneurs rely on a team of experts to manage their finances. He argues that no one can be an expert in everything, and trying to manage all aspects of your financial life on your own can lead to costly mistakes. By building a dream team, you can leverage the knowledge and experience of others to make more informed decisions and achieve better results. He compares building a dream team to assembling a championship sports team. Just as a successful team requires players with different skills and roles, your financial team should include professionals with expertise in different areas, such as investing, tax planning, estate planning, and legal matters. Key members of your dream team. Robbins outlines the key members of a successful financial dream team and the roles they play in helping you achieve your financial goals. 1. Financial advisor. A financial advisor is your primary guide in managing your investments and overall financial strategy. Robbins emphasizes the importance of choosing a fiduciary financial advisor who is legally obligated to act in your best interest. A good financial advisor can help you develop a personalized investment plan, manage risk, and make informed decisions about your money. 2. Tax advisor accountant. A tax advisor or accountant plays a crucial role in minimizing your tax liability and ensuring that you comply with tax laws. Robbins explains that effective tax planning can significantly increase your after-tax returns and help you keep more of your hard-earned money. A knowledgeable tax advisor can also help you navigate complex tax issues, such as business income, capital gains, and retirement account distributions. 3. Estate planning attorney. An estate planning attorney helps you plan for the transfer of your wealth to your heirs and beneficiaries. Robbins emphasizes the importance of having a comprehensive estate plan that includes a will, trusts, and other legal documents to ensure that your assets are distributed according to your wishes. An estate planning attorney can also help you minimize estate taxes and protect your assets from potential legal challenges. 4. Insurance specialist. Insurance is a critical component of financial planning, and an insurance specialist can help you assess your insurance needs and select the right policies to protect your assets and income. Robbins discusses the importance of life insurance, disability insurance, and long-term care insurance in safeguarding your financial security. 5. Business attorney. If you own a business attorney is an essential member of your dream team. A business attorney can help you with legal matters related to your business, such as contracts, intellectual property, and liability protection. Robbins emphasizes the importance of having legal expertise to protect your business interests and ensure compliance with regulations. 6. Real estate expert. For those who invest in real estate, having a real estate expert on your team can be invaluable. A real estate expert can help you identify profitable investment opportunities, negotiate deals, and manage your properties. Robbins explains that real estate can be a significant source of wealth, and having the right expertise can maximize your returns and minimize risks. How to choose the right team members. Robbins offers practical advice on how to choose the right members for your dream team. He emphasizes the importance of selecting professionals who have a proven track record of success, are aligned with your values and goals, and are committed to acting in your best interest. Robbins suggests the following steps for choosing your team members: research and referrals. Start by researching potential candidates and asking for referrals from trusted friends, family members, or colleagues. Look for professionals who have experience working with clients in similar financial situations and who come highly recommended. Interviews. Conduct interviews with potential team members to assess their expertise, communication skills, and compatibility with your goals. Robbins advises asking questions about their experience, approach to financial planning, and how they charge for their services. Fiduciary responsibility. Ensure that your financial advisor and other key team members are fiduciaries who are legally required to act in your best interest. Robbins emphasizes that working with fiduciaries helps align your team's incentives with your financial goals. Ongoing communication. Choose team members who are committed to maintaining open and ongoing communication with you. Robbins explains that regular check-ins and updates are essential for staying on track and making adjustments as needed. The benefits of a collaborative team. Robbins highlights the importance of collaboration among your dream team members. He explains that by working together, your financial professionals can provide a more comprehensive and integrated approach to managing your wealth. For example, your financial advisor and tax advisor can collaborate to develop tax-efficient investment strategies, while your estate planning attorney and insurance specialist can work together to ensure that your estate plan is properly funded and protected. Robbins also discusses the value of having a quarterback on your team, typically your financial advisor, who coordinates the efforts of all your team members and ensures that everyone is working toward the same goals. This collaborative approach helps you avoid gaps in your financial plan and ensures that all aspects of your wealth are being managed effectively. Building a long-term relationship. Finally, Robbins emphasizes the importance of building long-term relationships with your dream team members. He explains that as your financial situation evolves, your team will play a critical role in helping you navigate changes and adjust your plan accordingly. By developing strong, trusting relationships with your advisors and professionals, you can ensure that they are fully invested in your success and committed to helping you achieve your financial goals. Chapter 4.1 A Lifetime of Income. How to Design and Execute a Lifetime Income Plan. In this chapter, Tony continues the discussion on creating a lifetime income plan that ensures financial security and independence throughout your retirement years. While previous chapters focused on building wealth and managing investments, this chapter is about converting that wealth into a reliable income stream that can sustain your desired lifestyle indefinitely. Robbins provides a detailed guide on how to design, implement, and manage a lifetime income plan that will give you the confidence to enjoy your retirement without the fear of running out of money. The goal of lifetime income. Robbins begins by reiterating that the ultimate goal of financial planning is to create a lifetime income that can support you for as long as you live. He explains that many people focus on accumulating wealth during their working years but fail to plan how they will convert that wealth into a sustainable income stream during retirement. Without a proper income plan, even a large nest egg can be depleted too quickly, leading to financial insecurity in the later years of life. Robbins emphasizes that a well-designed income plan should provide consistent, predictable income that can cover your living expenses, healthcare costs, and any other financial goals you may have in retirement. The plan should also be flexible enough to adapt to changes in your circumstances, such as market fluctuations, inflation, and unexpected expenses. Steps to designing a lifetime income plan. Robbins outlines the key steps to designing a successful lifetime income plan. 1. Assess your retirement needs. The first step in designing a lifetime income plan is to assess your retirement needs. Robbins advises estimating your annual living expenses, including housing, food, transportation, healthcare, entertainment, and travel. He also suggests considering any one-time expenses you may have, such as home renovations or buying a new car. 2. Determine your sources of income. Next, Robbins encourages readers to identify all potential sources of income they will have in retirement. This may include Social Security benefits, pensions, annuities, rental income, business income, and withdrawals from retirement accounts. By understanding your income sources, you can determine how much additional income you need to generate from your investments. 3. Create a withdrawal strategy. A key component of your lifetime income plan is developing a withdrawal strategy that ensures your money lasts as long as you do. Robbins explains that this involves determining how much you can safely withdraw from your retirement savings each year without depleting your nest egg. He discusses different withdrawal strategies, such as the 4% rule, and suggests working with a financial advisor to develop a personalized strategy that takes into account your specific needs and risk tolerance. 4. Optimize Social Security benefits. Robbins emphasizes the importance of maximizing your Social Security benefits as part of your lifetime income plan. He provides tips on how to optimize your benefits, such as delaying benefits to increase your monthly payments and coordinating benefits with your spouse. Social Security can be a significant source of income in retirement, so it's important to make informed decisions about when and how to claim your benefits. 5. Consider annuities for guaranteed income. Robbins discusses the role of annuities in providing guaranteed lifetime income. He explains that annuities can be a valuable tool for ensuring that you have a steady income stream that lasts as long as you live. However, he also cautions that not all annuities are created equal, and it's important to carefully evaluate the terms, fees, and features of any annuity product before purchasing. 6. Plan for inflation. Inflation can erode the purchasing power of your income over time, so it's important to factor inflation into your lifetime income plan. Robbins suggests considering investments that have the potential to outpace inflation, such as stocks or real estate, and incorporating inflation-adjusted income streams, such as certain types of annuities or Social Security benefits. 7. Build a cash reserve. Robbins advises building a cash reserve to cover unexpected expenses or market downturns. Having a cash reserve can help you avoid selling investments at a loss during market declines and provide peace of mind knowing that you have a financial cushion to fall back on. 8. Review and adjust your plan regularly. Finally, Robbins emphasizes the importance of regularly reviewing and adjusting your lifetime income plan. As your circumstances change, your income needs and sources may also change, so it's important to stay flexible and make adjustments as needed to ensure that your plan remains aligned with your goals. The role of a financial advisor. Robbins discusses the value of working with a financial advisor to design and implement your lifetime income plan. He explains that a knowledgeable advisor can help you navigate the complexities of retirement planning, optimize your income sources, and develop a personalized withdrawal strategy. Robbins encourages readers to choose an advisor who is a fiduciary and has experience in retirement income planning. He also emphasizes the importance of communication and collaboration with your advisor. Regular check-ins and updates can help ensure that your plan remains on track and that any necessary adjustments are made in a timely manner. Protecting your income plan. Robbins highlights the importance of protecting your lifetime income plan from potential risks, such as market volatility, inflation, and longevity risk. He suggests considering strategies like diversifying your investments, purchasing insurance products, such as long-term care insurance, and planning for healthcare costs to safeguard your financial security. He also discusses the importance of estate planning in protecting your wealth and ensuring that it is passed on to your heirs according to your wishes. An estate planning attorney can help you create a comprehensive estate plan that includes a will, trusts, and other legal documents to protect your assets and minimize taxes. Chapter 4.2 Your Financial Freedom, a Reality Check. In Chapter 4.2, Tony Robbins provides a reality check on the concept of financial freedom, emphasizing that achieving true financial independence requires a clear understanding of your financial situation, realistic goal setting, and disciplined action. Robbins challenges readers to take an honest look at their finances and to confront any misconceptions or unrealistic expectations they may have. This chapter is about bridging the gap between where you are now and where you want to be, and it offers practical advice on how to close that gap effectively. Assessing your current financial situation. Robbins begins by stressing the importance of having a clear and accurate understanding of your current financial situation. He argues that many people have only a vague sense of their finances, which can lead to unrealistic expectations and poor decision-making. Robbins encourages readers to take a financial inventory, which involves assessing your income, expenses, assets, liabilities, and net worth. He provides a step-by-step guide to conducting a financial inventory, including calculating your income, determine your total monthly and annual income from all sources, including salary, bonuses, investments, and side businesses. Tracking your expenses, track your monthly and annual expenses, including fixed costs, such as rent or mortgage payments, and variable costs, such as dining out or entertainment. Robbins emphasizes the importance of being thorough and honest in this process to get a true picture of your spending habits. Listing your assets. Make a list of all your assets, including cash, investments, real estate, and valuable possessions. Include the current market value of each asset. Listing your liabilities. List all your liabilities, such as credit card debt, student loans, car loans, and mortgages. Include the current balance owed on each liability. Calculating your net worth. Subtract your total liabilities from your total assets to calculate your net worth. This figure represents your financial position at a given point in time. Robbins explains that conducting a financial inventory is the first step toward taking control of your finances and developing a realistic plan for achieving financial freedom. By knowing where you stand, you can set more accurate goals and make informed decisions about how to move forward. Setting realistic financial goals. Robbins emphasizes the importance of setting realistic financial goals based on your current situation and future aspirations. He argues that many people set goals that are either too ambitious or too vague, which can lead to frustration and a lack of progress. Instead, Robbins encourages readers to set specific, measurable, achievable, relevant, and time-bound SMART goals. He provides examples of realistic financial goals, such as building an emergency fund, setting a goal to save 3 to 6 months' worth of living expenses in a high-yield savings account to cover unexpected expenses. Paying off debt, setting a goal to pay off high-interest credit card debt within a specific time frame, using strategies like the debt snowball or debt avalanche method. Saving for retirement, setting a goal to contribute a certain percentage of your income to a retirement account each year, with a target savings amount by a specific age. Investing for growth, setting a goal to build a diversified investment portfolio with a target annual return, adjusted for your risk tolerance. Robbins emphasizes that setting realistic goals is crucial for maintaining motivation and making consistent progress. He advises readers to break down larger goals into smaller, manageable steps and to celebrate each milestone achieved along the way. Bridging the gap between goals and reality. Once you have set realistic financial goals, Robbins discusses the importance of creating a plan to bridge the gap between your current financial situation and your desired future. This involves developing actionable steps that you can take to achieve your goals, such as increasing your income, reducing your expenses, paying off debt, and investing more effectively. Robbins provides several strategies for closing the gap, including budgeting and saving, creating a budget that prioritizes saving and investing, and finding ways to cut unnecessary expenses. Robbins suggests using budgeting tools and apps to track your spending and automate your savings. Increasing your income, exploring opportunities to boost your income, such as asking for a raise, starting a side hustle, or investing in income-generating assets. Robbins emphasizes that increasing your income can accelerate your progress toward financial freedom. Debt reduction, developing a debt repayment plan that focuses on paying off high-interest debt first, while still making minimum payments on other debts. Robbins advises using strategies like the debt snowball method, where you focus on paying off the smallest debts first to build momentum. Investing for the future, creating an investment strategy that aligns with your risk tolerance and financial goals. Robbins encourages readers to focus on long-term, diversified investments that have the potential to grow over time. Robbins also discusses the importance of staying disciplined and committed to your plan. He acknowledges that there will be challenges and setbacks along the way, but he emphasizes that persistence and consistency are key to achieving financial freedom. The importance of regular progress checks. Robbins advises readers to regularly review their progress and adjust their plans as needed. He suggests conducting quarterly or annual financial check-ins to assess how well you are meeting your goals and to make any necessary changes to your strategy. Regular progress checks help ensure that you stay on track and remain motivated to achieve your financial goals. He also encourages readers to celebrate their successes, no matter how small. Recognizing and rewarding yourself for making progress can help maintain motivation and build positive financial habits. Chapter 4.3 The Wealth Factor. The Future is Bright. In this chapter, Robbins concludes his exploration of financial freedom by focusing on the concept of the wealth factor and why the future is bright for those who are prepared. Robbins aims to inspire confidence and optimism in readers, emphasizing that despite the challenges and uncertainties that may lie ahead, there are unprecedented opportunities for wealth creation and financial success. This chapter serves as a motivational call to action, encouraging readers to take advantage of the tools, strategies, and resources available to them to build a prosperous future. Embracing the wealth factor. Robbins introduces the wealth factor as a mindset and approach to life that prioritizes financial empowerment, growth, and abundance. He explains that the wealth factor is not just about accumulating money, it's about cultivating the attitudes, habits, and strategies that lead to long-term financial success and fulfillment. This mindset is characterized by a focus on opportunities rather than obstacles, proactive financial management, and a commitment to continuous learning and improvement. Robbins emphasizes that the wealth factor is accessible to everyone, regardless of their current financial situation. By adopting a growth-oriented mindset and taking consistent action, anyone can improve their financial situation and work toward achieving financial freedom. Robbins encourages readers to embrace the wealth factor as a guiding principle in their financial lives. The bright future ahead. Robbins argues that despite the challenges and uncertainties of the modern world, the future is full of potential for those who are prepared. He highlights several trends and developments that are creating new opportunities for wealth creation. Technological advancements. Robbins discusses how rapid technological advancements are transforming industries, creating new markets, and opening up opportunities for innovation and entrepreneurship. He emphasizes that those who are willing to adapt and embrace new technologies can benefit from these changes. Globalization. The increasing interconnectedness of the global economy is creating new opportunities for investment, business expansion, and collaboration across borders. Robbins explains that globalization is making it easier than ever to access new markets, resources, and ideas. Financial innovation. Advances in financial technology, fintech, are democratizing access to financial services, making it easier for individuals to invest, save, and manage their money. Robbins highlights the growth of online investment platforms, robo-advisors, and other fintech solutions that are lowering barriers to entry for investors. Changing demographics. Robbins discusses how shifting demographics, such as the aging population and the rise of the millennial generation, are creating new demands and opportunities in areas like healthcare, real estate, and consumer goods. He encourages readers to consider how these demographic trends might impact their investment strategies. Robbins emphasizes that while these trends present challenges, they also offer unprecedented opportunities for those who are proactive and willing to adapt. He encourages readers to stay informed about global and economic trends, to continuously educate themselves, and to be open to new opportunities for wealth creation. The importance of resilience and adaptability. Robbins stresses the importance of resilience and adaptability in achieving long-term financial success. He explains that while the future is bright, it will not be without challenges and setbacks. Economic cycles, market volatility, and unexpected events are inevitable, but those who are resilient and adaptable can navigate these challenges and emerge stronger. Robbins encourages readers to build resilience by diversifying their income streams, maintaining a flexible financial plan, and staying focused on their long-term goals. He also emphasizes the importance of continuous learning and staying informed about changes in the economy, technology, and financial markets. By being adaptable and willing to pivot when necessary, you can capitalize on new opportunities and protect your wealth from potential risks. Taking action today. Robbins concludes the chapter with a call to action, urging readers to take the knowledge and strategies they have learned throughout the book and put them into practice. He emphasizes that the key to achieving financial freedom is not just understanding the principles of wealth creation, but actively applying them in your life. He encourages readers to start by taking small, manageable steps toward their financial goals, whether it's setting up an automatic savings plan, investing in a diversified portfolio, or seeking out new income opportunities. Robbins argues that by taking consistent action and staying committed to your financial plan, you can achieve financial freedom and create a bright and prosperous future. Chapter 5.0 Creating Your Legacy, the Final Step to Financial Freedom. In this chapter, Robbins shifts focus to the concept of legacy, how you can create a lasting impact with your wealth and ensure that your financial success benefits not only you but also future generations and the causes you care about. Robbins emphasizes that true financial freedom is not just about achieving wealth for yourself but also about using that wealth to make a difference in the world. This chapter explores strategies for effective philanthropy, estate planning, and creating a meaningful legacy. The meaning of legacy. Robbins begins by discussing what it means to create a legacy. He explains that a legacy is about more than just passing on money or assets. It's about making a lasting impact on the people and causes that matter most to you. Robbins encourages readers to think deeply about the kind of legacy they want to leave behind and to consider how their financial success can be used to benefit others. He emphasizes that everyone, regardless of their level of wealth, has the potential to create a meaningful legacy. Whether it's through charitable giving, supporting family members, or contributing to a cause you're passionate about, your legacy is the lasting mark you leave on the world. The importance of estate planning. A key component of creating a legacy is estate planning. Robbins explains that estate planning involves making decisions about how your assets will be distributed after your death, ensuring that your wealth is passed on according to your wishes. He emphasizes that without a proper estate plan, your assets may not be distributed as you intended, and your heirs may face unnecessary legal challenges and tax burdens. Robbins provides an overview of the key elements of estate planning, including wills. A will is a legal document that outlines how your assets will be distributed after your death. Robbins explains the importance of having a clear and updated will to ensure that your wishes are carried out. Trusts. Trusts are legal entities that hold assets on behalf of beneficiaries. Robbins discusses the benefits of setting up trusts, such as protecting your assets from creditors, reducing estate taxes, and providing for loved ones who may need financial support. Power of attorney. A power of attorney is a legal document that gives someone the authority to make decisions on your behalf if you become incapacitated. Robbins emphasizes the importance of having a power of attorney in place to ensure that your financial and healthcare decisions are handled according to your wishes. Healthcare directives. Healthcare directives, such as living wills and healthcare proxies, outline your preferences for medical treatment in the event that you are unable to communicate your wishes. Robbins explains that these documents are crucial for ensuring that your healthcare decisions align with your values. Robbins also discusses the importance of working with an estate planning attorney to create a comprehensive estate plan that addresses your specific needs and goals. He emphasizes that estate planning is not just for the wealthy. Everyone can benefit from having a clear plan in place to protect their assets and provide for their loved ones. Strategies for philanthropy. Robbins explores the role of philanthropy in creating a legacy. He explains that philanthropy is the act of giving back to society, whether through charitable donations, volunteer work, or other forms of support. Robbins argues that philanthropy is a powerful way to use your wealth to make a positive impact on the world and to create a legacy that reflects your values and passions. He offers several strategies for effective philanthropy. Charitable giving. Robbins encourages readers to consider donating a portion of their wealth to causes they care about. He explains that charitable giving can be done through direct donations, setting up a charitable foundation, or creating donor-advised funds. He also discusses the potential tax benefits of charitable giving. Volunteering. In addition to financial contributions, Robbins emphasizes the value of giving your time and skills to causes you're passionate about. Volunteering can be a meaningful way to make a difference and to connect with others who share your values. Impact investing. Impact investing involves making investments that generate both financial returns and positive social or environmental outcomes. Robbins explains that impact investing allows you to align your investment portfolio with your values and to support companies and projects that are making a difference in the world. Legacy gifts. Robbins discusses the concept of legacy gifts, which are donations made through your estate plan, such as leaving a bequest to a charity in your will. Legacy gifts can be a way to ensure that your charitable giving continues even after your death. Robbins encourages readers to think strategically about their philanthropy and to consider how their contributions can have the greatest impact. He also emphasizes the importance of being intentional about your giving and aligning your philanthropic efforts with your personal values and goals. Passing on your values. Robbins explains that creating a legacy is not just about passing on wealth, it's also about passing on your values, beliefs, and life lessons to future generations. He encourages readers to think about the values that are most important to them and to consider how they can instill those values in their children, grandchildren, and other loved ones. He offers several ways to pass on your values. Family meetings. Robbins suggests holding regular family meetings to discuss financial matters, share your values, and educate younger generations about money management and philanthropy. These meetings can help create a sense of shared purpose and responsibility among family members. Letters and personal reflections. Robbins encourages readers to write letters or personal reflections that share their life lessons, experiences, and values with future generations. These writings can serve as a lasting reminder of what matters most to you and can provide guidance and inspiration to your loved ones. Creating traditions. Robbins discusses the importance of creating family traditions that reflect your values and beliefs. Whether it's a tradition of charitable giving, volunteering, or celebrating certain milestones, these traditions can help reinforce your values and create a lasting legacy. By taking the time to plan your legacy, Robbins argues that you can ensure that your financial success benefits not only you but also the people and causes you care about. This chapter serves as a powerful reminder that wealth is not just a means to an end, but a tool that can be used to create lasting positive change. Chapter 5.1 It's Time to Give, the Power of Contribution. This chapter delves into the power of contribution and the profound impact that giving can have on both the giver and the recipient. Robbins argues that true fulfillment comes not just from achieving personal financial success, but from using that success to make a positive difference in the lives of others. This chapter explores the psychological and emotional benefits of giving, as well as practical ways to incorporate philanthropy into your life. The emotional rewards of giving. Robbins begins by discussing the emotional rewards of giving, explaining that contributing to others can bring a deep sense of satisfaction, purpose, and joy. He shares research that shows how acts of kindness and generosity can lead to increased happiness, reduced stress, and a greater sense of connection with others. Robbins emphasizes that giving is not just about helping others, it's also about enriching your own life by experiencing the joy that comes from making a difference. He also addresses the common misconception that you need to be wealthy to give. Robbins argues that anyone can make a positive impact, regardless of their financial situation. Whether it's donating time, skills, or resources, there are countless ways to contribute to the well-being of others. The ripple effect of contribution. Robbins introduces the concept of the ripple effect, explaining how even small acts of generosity can create a positive impact that extends far beyond the initial recipient. He shares stories of individuals who started small philanthropic efforts that grew into significant movements, touching the lives of countless people. Robbins emphasizes that the ripple effect is not limited to large-scale initiatives. Even small gestures can inspire others to give, creating a chain reaction of kindness and generosity. He encourages readers to consider the broader impact of their contributions and to think about how they can create a ripple effect in their own lives. Practical ways to give back. Robbins offers practical advice on how to incorporate giving into your life, regardless of your financial situation. He suggests several ways to give back. Monetary donations. Robbins encourages readers to donate to charities or causes they are passionate about. He emphasizes the importance of researching organizations to ensure that your donations are used effectively and align with your values. Volunteering. In addition to financial contributions, Robbins highlights the value of volunteering your time and skills. He explains that volunteering can be a rewarding way to make a difference, build connections, and gain new experiences. Acts of kindness. Robbins suggests incorporating small acts of kindness into your daily life, such as helping a neighbor, mentoring someone, or offering support to someone in need. These simple gestures can have a powerful impact on both the giver and the recipient. Involving your family. Robbins encourages readers to involve their families in giving back, whether through family volunteer projects, charitable donations, or discussions about the importance of contribution. By making giving a family value, you can instill a sense of generosity and compassion in future generations. The power of gratitude. Robbins emphasizes the connection between giving and gratitude, explaining that cultivating a sense of gratitude can enhance your ability to give and to appreciate the impact of your contributions. He suggests practicing gratitude regularly by reflecting on the blessings in your life and expressing thanks to those who have supported you. Robbins argues that gratitude and giving go hand in hand. When you recognize the abundance in your life, you are more likely to want to share that abundance with others. He encourages readers to make gratitude a daily practice and to use it as a foundation for their philanthropic efforts. The legacy of contribution. Robbins concludes the chapter by discussing how giving can be an integral part of your legacy. He explains that by making contribution a core value in your life, you can create a lasting impact that extends beyond your lifetime. Whether through charitable donations, volunteer work, or acts of kindness, your contributions can leave a positive mark on the world and inspire others to do the same. Robbins encourages readers to think about the legacy they want to leave and to consider how giving can play a role in that legacy. By making contribution a central part of your life, you can create a meaningful and lasting impact that reflects your values and passions. Chapter 5.2 The Wealthiest People Alive: How to Pay It Forward. In this chapter, Robbins delves into the concept of paying it forward as a way to create a lasting impact and to continue the cycle of generosity. He emphasizes that wealth is not just about financial assets, it's about the value you bring to others and the legacy you leave behind. Robbins explores how the wealthiest people alive are those who have dedicated themselves to making a positive difference in the world, and he offers guidance on how you can do the same by paying it forward. The true meaning of wealth. Robbins begins by redefining wealth, explaining that true wealth is not just about money but about living a life of purpose, fulfillment, and contribution. He argues that the wealthiest people are those who use their resources, whether financial, intellectual, or emotional, to help others and to create a positive impact. Robbins shares examples of individuals who have achieved financial success but found true fulfillment in giving back. He explains that these individuals often experience a deeper sense of purpose and satisfaction by using their wealth to improve the lives of others and to contribute to causes they care about. The power of paying it forward. Robbins introduces the concept of paying it forward, which involves doing something good for someone else without expecting anything in return, with the hope that the recipient will continue the chain of generosity. He explains that paying it forward creates a ripple effect of kindness and generosity that can have a far-reaching impact. Robbins shares stories of individuals who have paid it forward in various ways, whether through small acts of kindness, mentoring others, or making significant charitable contributions. He emphasizes that paying it forward doesn't require grand gestures. Even small actions can have a profound impact on others. How to pay it forward. Robbins offers practical advice on how to pay it forward and make a lasting impact. Mentorship. Robbins suggests mentoring someone who could benefit from your knowledge, experience, or guidance. Mentorship is a powerful way to pay it forward by helping others achieve their goals and reach their full potential. Random acts of kindness. Robbins encourages readers to incorporate random acts of kindness into their daily lives, whether it's buying coffee for a stranger, leaving a generous tip, or offering help to someone in need. These small gestures can brighten someone's day and inspire them to pay it forward. Charitable giving. Robbins discusses the importance of charitable giving as a way to pay it forward on a larger scale. He suggests donating to causes you care about, supporting organizations that align with your values, and considering how your contributions can create a lasting impact. Creating opportunities. Robbins encourages readers to create opportunities for others, whether by providing scholarships, funding educational programs, or supporting entrepreneurs. By helping others succeed, you can pay it forward in a meaningful and lasting way. The joy of giving. Robbins emphasizes that paying it forward is not just about helping others. It's also about experiencing the joy and fulfillment that comes from giving. He explains that acts of generosity can create a sense of connection, purpose, and happiness that enriches your own life as well as the lives of others. Robbins encourages readers to embrace the joy of giving and to make it a regular part of their lives. He explains that giving doesn't have to be limited to financial contributions. It can also involve giving your time, energy, and attention to those who need it. Creating a legacy of generosity. Robbins concludes the chapter by discussing how paying it forward can become a central part of your legacy. He explains that by making generosity and contribution core values in your life, you can inspire others to do the same and create a legacy of positive impact. Robbins encourages readers to think about how they want to be remembered and to consider how paying it forward can help create a legacy that reflects their values and passions. By making generosity a lifelong habit, you can leave a lasting mark on the world and continue to make a difference long after you're gone. Chapter 5.3 Your Financial Freedom Action Plan. In the final chapter of the book, Tony provides a comprehensive action plan for achieving financial freedom. This chapter serves as a culmination of all the concepts and strategies discussed throughout the book, offering readers a step-by-step guide to putting everything into practice. Robbins emphasizes that while financial freedom is a journey, it's one that can be achieved by taking consistent, focused action. This chapter is designed to help you create a personalized roadmap to financial success. The power of taking action. Robbins begins by reiterating the importance of taking action. He explains that knowledge alone is not enough to achieve financial freedom. It's the application of that knowledge that leads to results. Robbins emphasizes that even the best financial strategies are worthless if they are not put into practice. He encourages readers to commit to taking action immediately, rather than waiting for the perfect time to start. Robbins argues that the sooner you begin implementing your financial plan, the sooner you will start seeing results. He also emphasizes the importance of consistency, explaining that small, regular actions can add up to significant progress over time. Step 1. Define your financial goals. The first step in your financial freedom action plan is to define your financial goals. Robbins advises readers to be specific about what they want to achieve, whether it's paying off debt, building an emergency fund, saving for retirement, or achieving a certain level of income. He emphasizes the importance of setting SMART goals, goals that are specific, measurable, achievable, relevant, and time-bound. Robbins suggests writing down your goals and breaking them down into smaller, actionable steps. For example, if your goal is to save $50,000 for a down payment on a house, you might break that down into saving $1,000 per month over the next 50 months. By setting clear, actionable goals, you can create a roadmap for achieving financial freedom. Step 2. Create a budget and track your spending. The next step in your action plan is to create a budget and track your spending. Robbins emphasizes that budgeting is essential for understanding where your money is going and for identifying areas where you can cut back and save more. He suggests using budgeting tools and apps to help you stay on track and to make the process as easy as possible. Robbins advises categorizing your expenses into needs, such as housing, utilities, and groceries, and wants, such as dining out, entertainment, and shopping. He suggests prioritizing your needs and finding ways to reduce your spending on wants. By creating a budget that aligns with your financial goals, you can ensure that you are making progress toward achieving financial freedom. Step 3. Build an emergency fund. Robbins emphasizes the importance of building an emergency fund as a critical step in achieving financial freedom. An emergency fund provides a financial cushion that can cover unexpected expenses, such as medical bills, car repairs, or job loss. Robbins suggests setting a goal to save 3 to 6 months' worth of living expenses in a high-yield savings account. He advises prioritizing your emergency fund before making other investments, as having this financial safety net in place can help you avoid going into debt when unexpected expenses arise. Robbins also suggests automating your savings by setting up automatic transfers to your emergency fund account each month. Step 4. Pay off high-interest debt. The next step in your action plan is to pay off high-interest debt, such as credit card balances, personal loans, or payday loans. Robbins explains that high-interest debt can be a major obstacle to achieving financial freedom, as the interest charges can quickly add up and make it difficult to save and invest. Robbins suggests using the debt snowball or debt avalanche method to pay off your debts. The debt snowball method involves paying off your smallest debts first to build momentum, while the debt avalanche method involves paying off your highest interest debts first to save money on interest charges. By paying off high-interest debt, you can free up more money to invest and save for your future. Step 5. Invest for the future. Once you have built an emergency fund and paid off high-interest debt, Robbins advises focusing on investing for the future. He emphasizes the importance of creating a diversified investment portfolio that aligns with your financial goals and risk tolerance. Robbins suggests investing in a mix of stocks, bonds, real estate, and other assets to achieve long-term growth and protect against market volatility. He also discusses the importance of maximizing contributions to tax-advantaged accounts, such as IRAs, Roth IRAs, and 401(k)s. Robbins encourages readers to take advantage of employer-matching contributions and to consider dollar-cost averaging, which involves investing a fixed amount of money at regular intervals to reduce the impact of market fluctuations. Step 6. Protect your wealth. Robbins emphasizes that protecting your wealth is just as important as building it. He suggests several strategies for safeguarding your financial assets. Insurance. Ensure that you have adequate insurance coverage, including health insurance, life insurance, disability insurance, and long-term care insurance. Robbins explains that insurance can protect you and your loved ones from financial hardship in the event of unexpected events. Estate planning. Create a comprehensive estate plan that includes a will, trusts, and other legal documents to ensure that your assets are distributed according to your wishes. Robbins emphasizes the importance of working with an estate planning attorney to create a plan that protects your wealth and provides for your heirs. Asset protection. Consider strategies for protecting your assets from lawsuits, creditors, and other potential risks. Robbins suggests working with a financial advisor or attorney to explore options such as liability insurance, asset protection trusts, and business structures that limit your personal liability. Step 7. Create multiple streams of income. Robbins encourages readers to create multiple streams of income as a way to accelerate their journey to financial freedom. He explains that relying on a single source of income, such as a salary, can be risky, especially in today's uncertain economy. By diversifying your income streams, you can increase your financial security and achieve your goals more quickly. Robbins suggests exploring opportunities to earn additional income through side hustles, freelance work, rental properties, or investing in dividend-paying stocks. He also discusses the potential benefits of starting a business or investing in passive income streams that can generate cash flow with minimal effort. Step 8. Give back and pay it forward. The final step in your financial freedom action plan is to give back and pay it forward. Robbins emphasizes that true wealth is about more than just financial success. It's about making a positive impact on the lives of others. He encourages readers to incorporate philanthropy into their lives, whether through charitable donations, volunteer work, or acts of kindness. Robbins explains that giving back not only helps others but also brings a sense of fulfillment and purpose to your own life. By making contribution a central part of your financial plan, you can create a legacy that reflects your values and makes a lasting difference in the world. By following this action plan, Robbins argues that you can achieve financial freedom, build lasting wealth, and create a meaningful legacy that benefits both you and the world around you. The chapter concludes with an inspiring call to action, encouraging readers to take control of their financial futures and to start making progress toward their goals today. Thank you for joining our quest for infinite growth. If you enjoyed this, please like and follow Infinite Self-Improvement on all social media and podcasts. We'll see you soon, but until then, remember that your potential is infinite.